Good evening, members. Welcome to the CP study circle on the topic of awareness program on taxation of shares and securities and income tax issues in JVA. Today we have a very eminent speaker, Mr. Narendra Jain and Bharath Lakshminarayana. I would request our committee members Tuppar and CP Jain to escort the speakers onto the dais and hand them over with the floor. Okay. Today's topic being a very tricky and a specialized topic which was carefully selected, but however due to the members who would be here for the benefit of them, and secondly we thought we will record this video and go on YouTube, and we have very eminent speakers who have been specialized in this area, so for the benefit of all the members we will be recording this video and putting it online. Now I request CPJ to introduce the speakers.
Thank you, Pramod. It's my privilege to introduce today's speaker, C. Narendra Jain, advocate, is a commerce graduate and a fellow character. He is also a compulsory and holds bachelor degree in law. Narendra has experience of over 17 years in advising clients handling tax litigations in income tax, transferring corporate tax, and international taxation, GST. His academic distinctions include All India Fifth Rank in CS Inter and other various awards to just specify a few. Taxman's Prize Award for securing highest marks in direct and indirect taxation, law and practice in CS planning. And he has co-authored various books like Analysis of Transfer Pricing Judgments published by CCH, co-authored a book on digital commerce and analysis of taxation aspects and emerging issues published by IFA Bangalore subchapter. Co-authored book Government Establishment Emerging Trends published by CTC and Taxman. Co-authored book New Age Assessment, Penalties and Appeals published by CAA. He is a regular speaker on various conferences, workshops, study circles, NADT. His teaching streams include teaching for CA finance students at CAPS on direct taxes, international taxation and transfer pricing from 2004 to 2018, and for CA finance students at Bangalore chapter. He was convener of Bangalore subgroup of Chamber of Tax Consultants, Mumbai for 2019-20, and Treasurer of International Financial Fiscal Association, Bangalore Sub-Chapter, 2018-20. Welcome, sir. I would like to introduce the second speaker of the day, Bharath Lakshminarayana. He is a Bachelor of Commerce and is associated with Singhi Devuni LLP, Characterization, Bangalore. He has over 16 years of experience in the field of taxation. He focuses on advising clients on Indian direct domestic tax and cross-border tax issues, tax optimization strategies, transfer pricing, and exchange control matters. He is also regularly attached to matters involving representation before the tax authorities and income tax appellate tribunal. He is also presently a co-convener of Bangalore Study Group of Chamber of Tax Consultants, Mumbai. I welcome you, sir. Now, I hand over the session to the speaker, Narendra.
Good evening. Good evening. Respected committee members and dear friends, it's a pleasure to be here. Though Pramod was a bit hesitant that there are very few members whether we should go ahead or not. In one of the conferences I heard the sentence rather from the speaker, that the responsibility of driver, whether there are 1 passengers or 50, is same. So as a speaker, whether there are few delegates or more, the effort what we would put would be same. So I would take this opportunity to discuss some interesting issues on taxation of shares and security. This particular topic of shares and security is very wide, and to cover it in 1.5 hours is not very easy. So what I will try and do is discuss certain important aspects, discuss certain important issues, discuss an overall concept of the taxation. And there have been so many changes in last few years, and constantly the revenue has tried to change the provisions. Wherever they have seen issues like, say, penny stock, they have tried to plug those loopholes. We had a particular methodology for taxation of long-term capital gains. It was changed. Exemption was given, then again it was reintroduced. Taxation is reintroduced. So there are a lot of issues, emerging issues in this particular area. And taxation of shares form a very important part when we really do the tax computation of, or when we file the return of income. And there are a lot of issues surrounding this taxation. At a broad level concept, though this was meant to be more focused on capital gains, but I will also touch upon the business income side of it briefly, so that we have a comprehensive view of the issues emerging on this topic. So what are the important aspects of taxation of securities? So securities, when we talk of as defined in section 2H of SCRA. So SCRA covers shares, securities, debentures, bonds. It covers derivatives, units of mutual funds, units of CIS. So it covers all these things. It also covers rights of interest in security. Rights of interest in security. It covers government securities. So it's a definition which we have to keep in back of our mind when we discuss taxation of shares and securities. The few aspects. One is the characterization of income. What is the characterization of income is what determines the taxation. Because there has been constant issue whether it will be taxed as business income or it will be taxed as capital gains. Right? We will discuss that aspect. Then comes the issue of timing, which year the taxation happens. Many times we see transactions like deferred consideration. So you sell the shares in the current year, but you may get consideration in subsequent year. Especially this happens in acquisitions and business restructurings, where a part of a consideration is tied to liabilities or future profitability, future turnover. So it is tied to those particular milestones. So the timing of taxation, what exemptions we get, and what is the computation mechanism. Computation also because of reintroduction of long-term capital gains tax a couple of years back, we have a specific issues arising out of that. And even otherwise, in normal circumstances, we will have the issues. Rate of tax, we have to have multiple rates of taxes, 111A, 112, 112A. Then if you are a non-resident, you have a complete set of rate of taxes. Surcharge changes have happened in last 2 to 3 years. We will try to see what are those changes. Interplay with DTA becomes very interesting if you have a non-resident who is having the tax, for whom you are filing a return as a non-resident. It could be a non-resident company, it could be a non-resident individual. If he is a non-resident Indian, then you have Chapter 12A benefits which can be taken. And if he is coming from a treaty favorable jurisdictions like Mauritius or Mauritius, no doubt is taxable, but there are jurisdictions where that kind of a situation may happen. Especially in treaty context, we have seen very interesting issues emerging. For example, the double dip that will happen. So, if you characterize a particular income under the treaty as business income, then the taxation will happen in the source country, which is India, only if the non-resident has a permanent establishment in India. Now, to do transactions of shares and security, the non-resident may really not have a permanent establishment in India. So prior to amendments to 115 AD, the issue was where the FIAs were doing a transaction, they said that ours is a business income. And given that we do not have a permanent establishment in India, the transactions in shares and security are not taxable in India. But however, in the year of loss, what happens? In the year of loss, they said, they took a view that, look, I don't want to take the treaty benefit. Under the Act, loss is eligible for carry forward and set off. So, you mean if it was a loss, they claimed it as a business loss, claimed the set off of those losses and carried forward those losses. However, if it was a gain, the exemption under the treaty was clear. And this was upheld also by various tribunal decisions like Prudential Assurance, Goldman Sachs, and Putney Computers. So double take what we call it happens in capital gains also. If you have a treaty exemption in capital gains, this kind of a situation may arise in capital gains also. So this interplay with treaty also becomes very interesting. No doubt the legislature tried to plug it by introducing 150 modifications to 115 AD and changes to the definition of capital asset. In the definition of capital asset, security held by FII was specifically treated as a capital asset. So those changes were made to say that they will specifically be taxed as capital gains and not be taxable as business income. So those changes were made to ensure that the treaty benefits were not misused. So these kind of issues these are the aspects which we will try and touch today. When we talk of characterization, the main issue that arises is whether an income can be classified as a business income or a capital gains. The next slide we will discuss in detail what are the parameters on which this has been discussed by various tribunals and circulars. But if you take it as a business income, then there are again two broad classifications, speculative, non-speculative. And their treatment as speculative or non-speculative also is important because of set-off of loss restrictions in section 73. Also, the speculative business becomes a separate business by virtue of expansion to section 28. So, if I have a transaction which can be classified as a speculative transaction, then their treatment will remain separate. I need to do a separate carry forward for that. And if you treat a particular income, when you treat these transactions in securities as business income, then what are the impact of it? You need to do compliances like, for example, your tax audits need to be done. You need to ensure that you follow the ICDS guidelines, which can be onerous in certain circumstances. The valuation of closing stock is also a critical aspect. Post amendment to 145 capital A, the ICDS today, if you have to value a closing stock in a security, you need to do that a category wise. Earlier ASP concept was you can do a script wise, share wise valuation you would have done, lower of market value or the cost, what valuation of closing stock we do. When we are doing this valuation, ideally you would have done a security wise or a particular share wise. So if I take share A, I would have taken that what is lower of market value or cost, I would have done for that for B also. But now you need to do categories wise. So listed share could be one category, debentures could be one category, bonds could be one category. So therefore there will be an impact on the valuation what you do when you classify it as a business income. So that would be one aspect that one has to take care of. When it comes to unlisted shares, unlisted and thinly traded shares, 45 capital A clause 3 very specifically says that in that you will always take the actual cost as the closing stock value. So if you treat particular transactions in securities as business income, then in those cases, if there are the shares of thinly traded shares or unlisted securities, in that you cannot take lower, say, net realizable value or fair market value cannot be taken as the valuation purposes of the closing stock. You need to take the actual cost as the closing stock. This does impact traders in stock market, NBFCs who have a huge portfolio of investment, may have a huge portfolio of investment in these kind of shares, or traders who are having this kind of investments. For them, there will be an impact on the closing stock valuation because of this. But when it comes to banks, they are specifically excluded from 145 capital A because they can still follow the RBI guidelines. 145A specifically says that for banks, they can follow the RBI guidelines and they can do the valuation. So these are certain aspects when you classify this income as business income, you need to be careful of. When it comes to turnover, as we all know, the institute had clarified that if it is a stock for which you are not taking delivery, or if it is like an option or a futures case, then only the premium amount will be treated as the turnover, both negative and positive value. In case of options, the premium amount. In cases where there will be a loss, the net effect will be what will go into the turnover and not the gross value will go into the turnover. So that also becomes very important for us to keep it in mind when we are deciding whether tax rate is applicable or not. Another aspect that emerges is what would be the turnover limit for triggering a 44AB audit. Right? We have 10 crore limit now when the cash transactions are below the threshold. So in shares of security, generally you will be dealing only to the banking channel. You will not be dealing in shares of security to the cash mechanism. Very rarely that kind of situation will arise. So in cases of transactions in shares and securities, you can easily say that 44AB tax rate provisions will be applicable only when the turnover threshold of 10 crores is crossed. 10 crores is crossed. So this is one benefit that one can take out of 44AB enhancement of limit, and in those cases one can say that 44AB tax rate is not applicable, as you can do a normal distribution of business income and file the return of income. Similar, another issue which comes up when we deal with the business income aspect is whether 44AB 8%, 6% limit. I did 6% because again this will all be the cases of online transactions and you don't find cash transactions. Eligible business is defined in a way where even business of trading in security will become eligible business. So if trading in business securities is an eligible business, can I declare 6% profit and go with it? Literally going by the language, strictly going by the language, and given that the carve-outs are very limited in 4480, technically if you read the section, 4480 also applies to the shares and securities. So if someone is disclosing less than 6% profit, possibly, and the turnover threshold of 2 crores is applicable, then in those cases you may have to get audit done on those cases also. So these are some aspects which I thought are very notable when we treat the income as a business income. Now when it comes to capital gains, then the taxation gets divided into short term and long term. This classification is very critical because of various aspects. One, naturally the tax rate is different. Second, the exemptions are tied up to long-term capital gains. Computation mechanism, indexation benefits, all these are very clearly linked to the classification between short-term or long-term capital gains. This also becomes very important because over the years, even this time period, what you can classify as long-term has been going on undergoing a change. We had 36 months, then 12 months and 36 months. Now we have three categories, 12 months, 24 months and 36 months. Right? So it is very important for us to keep it in mind that what will be covered in these things. And that in the subsequent slide we will see. And this classification impacts the loss set off also because long term can go against long term, whereas short term can go against both. So this is again something which we have to keep it in mind in this particular context. Let us first brush up the basics that how do you classify between capital gains and business income. This controversy is old controversy but became very important post 2004. Prior to 2004, short term was taxable at normal rate, business income was taxable at normal rate. So you didn't find much controversy in this area. No, there was a controversy, but you didn't find that many controversies. In 2004, when security transaction tax was brought in and short term was made at 10% and subsequently enhanced to 15%. So suddenly you had a rate differential. Business income taxable at 30%, short term taxable at 10% and subsequently at 15%. So this classification became very important. Whenever assessors started declaring it as short term capital gains, the revenue brought out a point that I will treat this as a business income and shifted that item to 30% taxation. So this became very important classification. This classification is important even today because the rate differential is there, plus the surcharge impact becomes very substantial. The last 2 years modifications to surcharge rules, the highest rate of surcharge of 25% and 37% is not applicable to 111. Right? So if something is classified under 111, which is the short-term capital gains, you have a highest bracket of surcharge of 15%. But if something goes to business income, then you have highest bracket of surcharge at 37%. So you have 15, 25 and 35 because depending on the total income, 2 crores, 5 crores And this classification also will impact your surcharge of other income. This will also impact your classification on the surcharge of the other income, because the Finance Act 22 amendment, what have they done in the Finance Act 22? They have said that 5 categories of income are outside the highest rate of surcharge and they will be taxed at 15%. Dividend income, 111A, 112 also is brought in. Keep this in mind that even land and building capital gains, which is taxed at 112 special rate, that also is now not liable for highest rate of surcharge. 112 and 112. So let's look at 4 items: dividend, 111, 112, 112. Now all these 4 items today, your highest rate of surcharge is 15%. So suppose I have 2 crores under 111, 112 I have 4 crores, and I have other income of 2.5 crores. So I have 8.5 crores of income, right? So 2 crores and 4 crores, the law very clearly says will be taxable. The maximum rate of surcharge is 15%. Now what happens to this 2.5 crores? What rate of surcharge this will be applicable? The total income now is 8.5 crores. 2 plus 4 plus 2.5, 8.5 crores is the total income. But the amendment which has been made with effect from Finance Act 23-24, this is for 23-24, even for this 2.5 crores, when you decide the limit of 2 crores, 5 crores for levying the higher rate of surcharge, you need to exclude the incomes which are dividend income, 111A, 112 and 112A, you need to exclude from it. So when you exclude from 8.5 crores these 3 categories of income which I am having, 2 categories of income in my example, 111A and 112, then my total income is 2.5 crores. And on 2.5 crores the rate of surcharge is 25%. So this you have to keep it in mind that with this assessment here, the surcharge also will vary depending on whether it is an income which is coming under 111, 112 or 111, 112 or 112. It's a very important modification which needs to be kept in mind. So this classification that it is a short term or it is a business also impacts how the tax will be computed, not just on that income but other income also. So this is another important thing that has to be kept in mind. Then if you classify the income as business income, as discussed in last slide, you will follow the rules of 28 to 44 AD. You will claim the deduction for expenses and so on and so forth will be applicable to you. Now, board has early has in 89 clarified that what are the parameters that we should look at while deciding that the income is capital gains or business income. What they said, and over the years this process has been refined and very clear-cut tests today emerge out of various circulars which really help us to decide whether it can be capital gains or business income. So they are referring to various Supreme Court decisions. The board in 89 said whether the purchaser was a trader or purchaser of a commodity or its resale were allied to his usual trade or business or whether incidental to it. So one of the tests. The nature and quantity of commodity purchased and resold. The commodity purchased is very large quantity. It could tend to eliminate the possibility of investment for personal use. The repetition of transactions. So these are some tests emphasized by the board in 89. Nature and quantity and repetition of transaction and what is the commodity in which you are particularly doing it. Refined in 2007, specifically referring to an AR, and very important or very good observations by AR in this particular case. They said where the company purchases and sells shares, it must be shown that they are held as stock in trade and that existence to power to purchase and sell shares in the MOA is not decisive of the nature of transactions. So how you have classified whether it's a stock in trade and what is the classification or power to purchase in MOA. So power to purchase in MOA will not be very relevant, but classification in stock in trade is a relevant test. The substantial nature of transaction, the manner of maintaining books of accounts, the magnitude of purchase and sales, and the ratio between purchase and sales and holding would furnish a good guide to determine the nature of transactions. So second test based on the AR1. Ordinarily, the purchase and sale with a motive to earning a profit would result in transaction being in the nature of trade adventure, in the nature of trade. But when the object is investment in shares of a company, is to derive income by way of dividend, and then profits accruing on change of such investments will yield capital gains and not revenue sales. So So these are three parameters which the board highlighted in 2007. But important circular came in 2016, where more clear-cut guidelines were given, and this is a very critical one which we should keep it in mind. Okay, so what it says, if the taxpayer himself opts to treat a listed shares, first they discuss the listed shares, then subsequently they discuss the unlisted shares, also will come to that. If the taxpayer treats the listed shares and other securities as stock in trade, then irrespective of period of holding of these listed shares and securities, the income arising from transfer of such shares or securities would be treated as a business income. So first they said, if the assessee himself is treating it as stock in trade, so business income, then the AO should never dispute it. Very clear, the AO should never dispute it. There are 2 or 3 exceptions that will come there. But in a general circumstances, if the assessee himself treats it as business income, then there is no circumstance in which the AO should dispute it. The next one, if it's a listed share and the assessee is held for more than, the asset is held for more than 12 months immediately preceding the date of its transfer, and the taxpayer desires to treat the income arising as capital gains, the same shall not be to dispute by the AO. Again, a clear-cut guidelines that if it is a listed shares more than 12 months, then in no situation the AO should dispute the classification made by the assessee. The caveat for this was, however, once the stand is taken by the taxpayer in the particular assessment year, then the taxpayer will be bound by the same stand in the subsequent assessment years also, and the taxpayer will not be allowed to adopt a different or contrary stand in the subsequent years. So what this particular statement says is that if the assessee, if the holding is more than 12 months, treat it as long-term capital gains. Period. There is no dispute that the AO should do about it. The condition is the assessee should be consistent in its approach. You cannot do flip-flop. In 1 year I treat it as long-term capital gains, next year I want to treat it as a business, there is going to be a problem. So if the assessee is consistent in treating these kind of securities as capital assets, in those cases the assessing officer has no power. AO should not dispute it on it. The assessee's classification should be accepted. In other cases, the nature of transaction shall be continually guided by the earlier circulars which we have discussed in the earlier 2 slides. Then the next clarification came in 2nd May. So the question was raised is, look, you have gave the clarification for listed shares, what about unlisted shares? And unlisted shares do not have marketability, you cannot sell it in open market. So therefore it is more a reason that it should be treated as capital gains because it is not freely transferable in the market. So board in second clarification on 2nd May 2016 clarified that if it is unlisted shares, irrespective of period of holding, it will be treated as capital gains, and irrespective of period of holding, it can be treated as capital gains. That will now become the choice of the assessee, that if you are treating these kind of transaction, first thing will be the choice of the assessee. Only exceptions to these 2 instructions was given in the instruction of May 2016, that if it is a sham transaction or fraudulent transaction, in those cases these instructions will not be applicable, or these circulars or the benefit given on these circulars will not be given. Fraudulent transactions like, for example, your penny stock cases, dividend stripping or bonus stripping kind of cases. So there could be sham cases or fraudulent cases. In those cases, the revenue may try to disallow the benefit of this particular circular. Second exception was if they want to lift a corporate bill. For some reason they want to say that we will look below the corporate structure and lift the corporate bill. In those cases, the benefit of circular may not be applicable. This could happen where you are transferring a share, but real intention is to transfer an underlying asset in the company. So if the company holds land, just an example, the company holds a land and building and someone wants to transfer a share, the real intention is to transfer land and building, and the revenue feels that there is a necessity to invoke lifting of corporate bill. In those cases, this is not done. The third exception which was provided in the circular, which is very, I don't know why they have provided it, they say that if along with transfer of shares, you are transferring the control and management, then in those cases the revenue can look into those transactions in a normal circumstances. But that is very absurd. Anyone holding a shares with an intention to have control and management, then that asset, as Supreme Court decided way back, will always be classified as long-term capital, will be classified as capital asset. So that Narendra says 41 India 534. The Supreme Court said that where you are having this kind of a situation where you hold and share for the purpose of control and management, it is necessarily a capital asset. To that extent, this circular, the last exception, doesn't appear to be proper. The first two exceptions, possibly revenue want to look at cases of fraudulent cases or sham cases. In those cases, the revenue may want to invoke and say that it will deny you the benefit of the circular. Possible. So, if you suggest to summarize the tests, what are the tests? Intention at the time of purchase, object clause in MOA. So, what is the assessor's conduct, intention, conduct, object? So, that becomes very relevant. What is its major source of income? If the assessor's major source of income is only capital transfer, gains from transfer of shares and security, in that case, yes, the revenue may be right to say that, look, this is a regular trader and therefore we want to treat it as business income. At that time, you will lose those benefit of surcharge and other things if the income is crossing a particular threshold. So, conduct of the assessee, and if that is the only source of income, that's the intention at the time of purchase, that can be gained from the kind of minutes is recorded or what is written in the MOA. That would be one of the ways to look at it. Treatment in books of accounts. Your classification in the books of accounts as investment or stock in trade is one of the major criteria for you to decide whether it is business income or capital gains. Valuation of stocks, valuation of closing stock of shares and securities, that could be one of the guiding factors to decide whether it is a business income or closing stock. Sometimes this also faces challenge because the AS13, even the investments, long-term investments, if it is a permanent diminution in the value of investment, even that has to be provided. And the assessment officer may not understand this, and he may say that you have made a provision, therefore you are revaluing the shares and therefore they stop in trade. So that kind of situation may arise, but that is not something which is very important. So if you have done a reclassification provision identified for diminution of value of the asset under AS13, that may not be very relevant. But your treatment as closing stock, as a stock or as an investment will be a guiding factor. Ratio between quantum of purchase and sales, how much value of purchase and shares. Ratio between purchase and sales. So if you are an investor, your ratio between purchase and sales will not be 1:1. When you are a trader, you will buy and sell. So that would generally be the ratio of 1:1 when you are having the purchase and sales, right? As a trader. But as an investor, in 1 year purchase may be higher, in 1 year sales may be higher. So that is one of the factors that one need to consider while deciding whether it is business income or capital gains. Kind of assets also could be relevant. There are some tribunal decisions which have taken a view. If you invest in mutual fund, it is always capital gains. Because mutual funds, we are really not having open market, you are not doing it trading in the stock market except ETFs and other things, but general units of mutual funds, you will only go back and redeem. So they said if the asset itself is mutual funds, then we will treat it as a capital gains. So that could be a relevant factor that needs to be there. Period of holding, as I said, the circular very clearly said if it is more than 12 months, listed shares, unlisted shares, very clearly it becomes long-term capital gains. Frequency, continuity, regularity of transactions, we all know this. Source of acquisition, whether owned funds or loan funds. Borrowed funds can indicate that it is a business income. It is not a very mandatory test, but it can indicate that it is a business income. And the last point is the instructions of 2007, the circular of 2007 also very clearly said that the assessee can maintain two portfolios. One, he can maintain as capital asset and one he can maintain as business. So if the assessee himself has classified these as business income and capital asset, in those cases that classification should be respected. So within assessee being a trader, he having stocks as closing stock, if he classifies certain shares as long term and his conduct indicates that he is holding those shares for long term, for those shares taking it as long term capital gains, there is no bar. You can still do it. So I have 10 shares and 2 shares I am holding for 5 years and we really want to hold it for long term capital gains. It is clearly possible by virtue of 2007's instruction circular saying that it can be treated as two different portfolios, one trading portfolio, one capital gains portfolio. So assessee can look at these activities, can decide how in a particular cases this can be done. The assessee's conduct pre-acquisition and post-acquisition also will indicate what is his nature. Again, it may not be it could be guiding factor. So I sell and invest in a house, that indicates that I want to keep it, I hold it as a capital asset. But I am turning around of a closing stock, continuously turning around of a stock, then there will become business income. So these are some parameters that we all need to keep in mind while doing this classification. I will say consistency is very important, because the tribunals are consistently taking a view that if the assessees take what is consistent view, if earlier you have treated as capital asset, treat it as a capital asset. This has been quite a few decisions in this particular direction, saying that consistency is the most critical test which one will apply. No doubt the other tests are also important, but consistency is very important test. So the conduct of the assessee should be consistent, and then we can decide what should be the classification in this particular cases. Speculative will not spend much time, just to highlight that the cases of what can be treated as speculative: purchase, sale of any commodity, goods, stocks and shares. The transaction is periodically and ultimately settled, otherwise than actual delivery or transfer of a commodity or security. So intraday transactions of shares where there is no actual delivery happening, those cases will go into this particular domain. But there are exceptions. For derivative we have exceptions, for others we have exceptions. So if you fall in those exceptions, I can say that it is not speculative. As already highlighted, speculative is treated as a separate business, and the benefit is the problem is you can't set off this loss for speculative against the normal business income, and carry forward is restricted to 4 years. So this again is important what you have to keep in mind. There are 5 exceptions. Hedging contract in respect of raw materials and merchandise. So if you are purchasing certain raw material, you hedge it, then it is not speculation. These are exceptions to speculation. So if even in these cases, if there is no delivery, but still it will not be treated as speculative. So hedging contract in respect of raw material or merchandise, hedging contract in respect of stocks and shares, then forward contracts, trading in derivative is not speculative. A lot of people get confused with it, but 43.5 very specifically says trading in securities is not speculative. Derivatives, as I highlighted, is a security under 2 heads of SCR. So it could be capital gains if you have, again depending on the test what we have discussed. So if you have 1 or 2 transactions or few transactions, derivative also would be a long-term or short-term capital gains. But if you have huge amount of transactions, naturally it becomes business income. So this is our trading in commodity derivatives. So both of these derivatives specifically excluded from the test of speculative transactions, by exceptions. Compliance for business income we discussed about 44AB tax rate and other things. What is the holding period? You can see the list of assets and the changes that have happened over the years. Listed security, 12 months test we have. Unlisted shares. Shares could be private, listed shares or unlisted shares. Today the test is 24 months. Preference shares listed 12 months, unlisted 24 months. Securities 12 months. Debt oriented mutual funds 36 months. REITs, InvITs 36 months. Zero coupon bond in all cases is 12 months. Immovable property being land or building is 24 months. Any other is 36 months. So we have 3 broad categories: 12, 24 and 36. If it is listed, in most cases it will be 12 months. So any listed security, shares, preference shares, bond, debentures will always be 12 months. If it is unlisted and immovable properties, it will be unlisted shares, only unlisted shares. If you go to other unlisted cases like debentures, etc., those are not 24 months. So when it comes to 24-month criteria, it is only share of a company. So unlisted share of a company. Or land and building, land or building or road. So those will be 24 months. Now apart from that, any other asset will go to 36 months. So this is a broad classification we need to keep it in mind. As I just highlighted, the rate of taxes, because 111 gives us 15%, 112 maybe 20, maybe 10, most cases it is 20%, 10% for listed securities. Listed securities, 111 gives us 10%. So this will impact the tax rates. This classification will impact the tax rate. So this is something which we have to keep it in mind. New regime will briefly discuss, and then we will go into some interesting issues. So post 2018-19, the capital gains regime was changed. Broadly, it was keeping in mind the penny stock issue which was there. Prior to that, they made certain modifications in exemptions of 1034. They issued a notification in 1038 and restricted the benefit of exemption to certain category of shares. Then it came to 112, they thought it fit to make it taxable. And from even 1920 onwards, it becomes a taxable at 10% rate. And the gains accruing up to 31st Jan 2018 are not taxable. So whatever is the gain that accrues to the assessee up to 31st Jan 2018 is not taxable. In a similar sense, the losses up to 31st Jan 2018 is also not allowable as a deduction. So when is the new scheme applicable? Total income includes income chargeable under the head capital gains. Capital gains is on account of transfer of long-term capital asset, being an equity share in a company, unit of equity-oriented mutual fund, or a unit of business trust. STT has been paid in case of equity shares on acquisition and on transfer of shares, and in case of units of equity-oriented mutual funds or business trust on transfer of units. So these are the triple condition which we have to satisfy. That there is an income under head capital gains, it is from long-term capital assets, and it is equity shares, business trust or mutual fund, equity-oriented mutual funds, and STT paid on purchase and sale. When it comes to STT paid, we need to be aware of a notification which has been issued excluding certain category of shares on which STT may not be paid. For example, acquisition prior to 2004. In those cases, the STT was not leviable. So, though on purchase the STT is not paid, then it will still be eligible for 112A. However, there is a notification itself covers various cases, and you need to see which case the particular case falls. For example, ESOPs are there. Investment by FDI. When it was invested, the company was unlisted and subsequently it is listed. And then the sale happens when it is listed. The shares may be acquired through transactions like mergers, acquisition, which are covered under say 47, and then subsequently the shares are sold. So the notification covers these kind of cases where specifically you need not pay STT on purchase. No doubt on the sale you will still pay the STT, but on the purchase you will not pay the STT. So if you fall within the ambit of that notification, in those cases, though you have not paid STT on purchases, still you can claim the benefit of 112 capital gain. The notification also provides that if it is a case of thinly traded shares, in those cases, though you might have paid STT, or there could be a situation where you acquired those shares during the delisting period, but after that they are listed, but they are thinly traded shares. In those cases, the benefit of 112A lesser rate is not available. So this is again to curb the practice of penny stock menace, where they are trying to say that thinly traded shares will not give you the benefit of 112 capital gain. One needs to be aware of these provisions. If that kind of a share situation is there where thinly traded shares, in those cases, if on purchases STT is not paid, though it may be unlisted at that particular point of time, subsequently it may get listed but it is still a thinly traded share. In those cases, the benefit of 112 capital A will not be applicable. 112 capital A will not be applicable. Post this amendment, now the loss naturally can be carried forward, but it can again be set off only against the long-term capital loss. It cannot be set off against the short-term capital loss. No indexation benefit will be available under the new regime. There is a basic exemption of 1 lakh rupees, and it is like a basic exemption. So you pay only above the gains on above 1 lakh rupees. Cost of acquisition is specifically defined, and for that we need to see 55 to AC. And cost of acquisition is higher of cost of acquisition of such asset. Suppose it was 100 rupees, your cost of acquisition is 100 rupees. You compare this with lower of FMB on 31st Jan 2018. So FMB on 31st Jan is say 500 rupees, and you actually sell it subsequently at 600 rupees. So when you come to item 2, clause A and clause B, you need to compare 500 and 600. 500 is FMB on 31/1/2018, and you need to see your sale consideration. Lower of this becomes the second, clause 2, and compare this with cost of acquisition. So if I take the one simple example, 100 rupees is my cost of acquisition. 31st Jan 2018, my FMV is 500 rupees. FMV is defined as highest value or highest trading value on the 31st Jan 2018 of the listed shares. And the actual sale consideration is 600 rupees. First I need to see what is lower of 500 and 600, which is 500 rupees. Then I compare this with cost of acquisition and take what is higher of 100 or 500, which is 500. The idea of this is, particular calculation mechanism is, whatever is the gain up to 31st Jan 2018, that should be exempted. You will not pay tax on that particular gain. Right? Now, if the sale consideration was less than 500 rupees, so you would got a sale consideration of 300 for example. So you sell in April, there is a market crash, you are selling it at 300 rupees. Then what happens? If you see the clause 2, lower of 500 and 300. So 300 will be compared to 100. So 300 vis-a-vis 100, 300 becomes cost of acquisition, sale consideration is 300 rupees. So your gains will become nil, 0. So you don't get the loss also, you don't get the loss also. Whereas if I take the first example again, 100 rupees, FMV 500 rupees, sale consideration 600 rupees. So your cost of acquisition becomes 500 rupees, you have sold at 600 rupees, so 100 rupees is the gain. So the 112A tax will be paid on 100 rupees, and that is what will be liable for tax. However, it may happen that there are certain category of shares for which may not be listed on 31st Jan. So in those cases, two specific categories they have clarified that equity shares which are not listed on 31st Jan 2018 but listed at the time of transfer. For example, Zomato, which was not listed on 31st Jan 2018 but it is listed subsequently. Equity shares listed on the date of transfer and which become the property of the associate through an exempt transfer covered under section 47 in consideration of share which was unlisted on 31st Jan 2018. So if you take the first example, capital A here, Zomato shares I acquired in 2015, so say to preferential allotment by Zomato, and I am selling it today. Now, will the entire gain be taxable? No. The calculation mechanism under 55 provides that in those cases we will take cost inflation index of your year of acquisition of 2015 and 31st Jan 2018, so financial year 17-18. So cost inflation index on 18, financial year 17-18, you give that much of benefit of indexation. So suppose it was 100 rupees is my cost of acquisition, and applying the indexation I get 150 rupees or 160 rupees, then that becomes the fair market value. So the gain accruing for that period by virtue of indexation is not taxable, and I will then sell it at a particular price. So if I acquired at 50 rupees, by applying indexation it becomes 70 rupees for example, then that 20 rupees is not taxable. And if I sell it at 90, then only 20 rupees is taxable. So the 90 minus 70 becomes taxable. Or I sell it at 100, 100 minus 70, 30 rupees becomes taxable. Second clause B, the second situation here, clause B, provides that if you get a shares, suppose there is a subsidiary company and that merges into holding company, and you get the shares of holding company which are now listed, the subsidiary was unlisted. Now you are getting a share of a listed company which will subsequently sell, right? Now your acquisition of a shares of subsidiary company you have not paid STT. It was also not listed on 31st Jan 2018. So how do you give the fair market value FMV on 31st Jan? To calculate FMV on 31st Jan, again apply the indexation benefit. So these two cases, they are given the benefit of indexation, and there you can index from the date of acquisition to financial year 17-18, and the indexed gain will not be taxable. That indexed gain will not be taxable. Same benefit accrues to bonus shares and right shares. Bonus shares which are acquired before 31st Jan 2018, FMV on 31st Jan 2018 becomes cost of acquisition. Right shares you might have acquired prior to 31st Jan, but the FMV highest market price for 31st Jan 2018 becomes the fair market value. So these are some broad outlines of this new scheme of taxation. Then we look at interplay between 50 CA and 56(2)(10). This is very important because if you are transferring certain category of shares, in those cases, unquoted shares, in those cases 50 CA is attractive. And these two provisions, interplay of these two provisions, necessarily lead to double taxation in the hands of buyer, in the hands of seller. In the hands of seller, 50 CA will be applicable. In the hands of buyer, 56(2)(10) will be applicable. Now, this is very similar to the notional taxation that is happening in the hands of by virtue of 50 C and 56(2)(10). So, if you transfer an immovable property below stamp duty value, for a buyer, 50 C will jack up the value to the stamp duty value, and for the seller, it will take up the stamp duty value. Sale consideration will move up to the stamp duty value. For the buyer, 56(2)(10) will be applicable. So there could be incidence of double taxation in both the hands. You can take a simple example to understand this. So there is a, say, transferee A limited, transferor B limited, seller B limited, buyer A limited, and 100 rupees shares is being transferred. Okay. Now the transfer is at 600 rupees, so you get 60,000 rupees as sale consideration, right? But the price FMV, which is calculated as per rules, rule 11 UA, is 700 rupees. So in case of transfer, seller B limited, his sale consideration by applying provisions of 50 CA, though he has actually got 60,000 rupees, will become 70,000 rupees, right? His cost of acquisition is 50,000 rupees, so he will pay capital gains tax of 20,000 rupees. When you come to transferring, he actually purchases at 60,000 rupees, but given that the fair market value applying to rule 11 UA is 70,000 rupees, so for him 10,000 becomes taxable as income from other sources. So you will see that where only seller should have been taxed at 10,000 rupees, total taxation is 30,000 rupees, 20,000 rupees in the hands of seller, 10,000 rupees in the hands of buyer. From the point of view of buyer, 49(4) will protect him. So if the buyer today who has purchased this shares at 600 rupees, after say 3 years he sells this subsequently of 900 rupees. So already because he has paid tax on 700 rupees, he will get the jack-up of the cost. And though his actual acquisition price was 600 rupees, by applying provisions of 49(4), his purchase price will become 700 rupees. So to some extent the transferee will be protected. To some extent the purchaser will be protected. Buyer will be protected. In our example, A limited will be protected. No doubt that is in future if he sells the shares. If he never sells the shares, anyway he pays the taxes. Right? So this leads, the interplay between 50 CA leads to a situation where this kind of a problem of double taxation will arise. So 50 CA versus 56(2)(10), one has to be very careful in mind. The problem is the rule 11 UA. The way rule 11 UA defines the calculation is very specific. It says you go by the asset. Broadly, it says asset minus liability. But when you value the asset, you have to make certain exceptions. So if you have an immovable property in the asset, you will go by the stamp duty value. The actual value may be more or less. That is not a consideration. So if you have an asset like land, that gets substituted by the stamp duty value. On the asset side, you have assets like jewelry, work of art, etc. Those you need to say market price. Those you need to see market price. Again, these are very subjective. You don't have an open market for art or other things. For jewelry, at least you can identify the price. The problem arises that if in case of the company whose shares you are transferring, that company has shares of another company. You sell shares of A has the share of B as an asset. B has the share of C and C has the share of D. Now, the law would say that you also value share of B, C, D in the same fashion. So first I have to value share of D in the same methodology applying 11 UA. Then take that value to C, then take that value to B, and then take that value to A. So in this process, there will be situations from the actual consideration that the assessee has agreed upon. This now does not respect the transaction between unrelated parties, and it could be actually negotiated share purchase agreement, and they might have been discussed and taken into. That is not taken into consideration in this particular thing. The Supreme Court in Hari Singhania's case, Hari Kumar Singhania's case, in the context of Wealth Tax Act, that valuation rules are mandatory. It used to be followed. And if there are multiple valuation rules and the legislature has thought it fit, the government has thought it fit to prescribe one valuation rule, then that is mandatory. You may like it or not like it, it's a different issue. You have to follow it. So given that circumstances today, we are having a rule of valuation under 11 UA, and we have no choice but to follow this valuation rule. It says we will value on the date of transfer. Now on the date of transfer, I will not really have an unaudited audited balance sheet. Then even we will all give a disclaimer that it is unaudited balance sheet and valuation is done on this basis. You may really not get the correct stamp duty value details also on the date of transfer. You will not get correct market price value on the date of transfer. And main challenge will be when this multi-layer entities are there, A, B, C, D, value all of them. And if some of these are foreign entities, then valuing that also becomes an issue. No doubt there is a merchant banker certificate and things like that, we will all do it. But this creates a situation where the fair market value will be different from the actual consideration, and that will lead to complications in taxation. Even if it is less or more, that will always be a trouble in one end of the cases. So that one has to take care. This is in the context where of unlisted shares only. No doubt listed shares, at least this is not applicable because there is an open market for that. But in every transaction of unlisted shares, one needs to be very careful of the provisions of CA 56(2)(10). 56(2)(10). And it will be applicable only where there is a consideration received for transfer of unquoted shares as capital gains in the hands of transfer. So there should be consideration received or accruing. In cases where there is no consideration received or accruing, if in circumstances there is no consideration received or accruing, then 50 CA will not be applicable. In other cases where there is consideration received or accruing, in those cases 50 CA will be applicable. Then let us look at some recent issues emerging out of case law. I have selected two topics which would be of interest. One is the case of Dinesh Vajdani. We are discussing the concept of deferred consideration. In a business deal, many times the consideration is deferred. It could be deferred because suppose I am acquiring a company, it could be deferred for reason that there is certain liabilities which may arise in future, contingent liabilities. It may be deferred based on turnover criteria, profitability criteria, that will get it. So suppose today I transfer a share of a company and the transfer consideration is agreed at say 1 crore rupees and 20 lakhs is deferred to year 2 or year 3. Then what is my sale consideration? Is it 1 crore or is it 1 crore 20 lakhs? This is a very regular feature. Generally this additional consideration of 20 lakhs is kept in escrow account, and if the conditions of escrow are satisfied, after 2 or 3 years, depending on your share purchase agreement, you will get the balance 20 lakh rupees. This is a very regular feature in any business deal, and this contingent consideration is very regular feature. Many times there are circumstances that out of, in our example, 20 lakh rupees, you may just get 10 lakh rupees. So how do I offer this to tax? Multiple issues arise. First, what is this consideration of 20 lakh rupees? Is it something related to transfer of shares? Can I classify this as capital gains, or will I classify this as something else? When does this 20 lakh accrue? In the year of transfer of shares, or it accrues in the subsequent year when I really receive it? And how do I tax it? By the time I get this consideration, the time limit to file revised return may have lapsed. No doubt today they have brought in updated return concept, but you need to pay additional taxes for that, right? 25 additional taxes for that. And given that there is a very limited time when you have to file revised return, in all probability it is not possible to file revised return for this kind of situations. Because these kind of situations generally would say 3 years to get the balance consideration. It can also be staggered. So if you have additional consideration of 20 lakh rupees, it could be 5 lakhs in each of the year for the next 4 or 3 years. The earlier jurisprudence on this particular aspect, if you see case decisions of various high courts, both foreign at least, the decision of Bombay High Court in Hemal Raju said, there the Bombay High Court said that there is no accrual of deferred consideration or additional consideration. In the year of transfer of share, there is no right that the assessee gets to get this additional consideration. So there is no right accrued in favor of the assessee. There is no right accrued in favor of the assessee. So they said this additional consideration is not taxable. They do not dwell on the aspect that how will this additional consideration be taxable in the subsequent year. So will it be taxable in the subsequent year or not? That aspect is not discussed in the decision. The decision just says that this additional consideration, in our example 20 lakh rupees, does not accrue to the assessee and therefore it is not taxable. In case of universal Medicare, there the consideration was deferred in subsequent years and the assessee had offered the consideration in subsequent years as capital gains. Now, if you see section 45, the capital gains is taxable in the year of transfer of capital asset. It doesn't say capital gains is taxable in the subsequent year. The exception is enhanced compensation, where there is a specific provision that in case of enhanced compensation, we will tax it in the year of receipt. But when you talk of normal assets, the capital gains is always taxable in the year of transfer. So, this particular case, universal Medicare, the assessee offered the deferred consideration in the subsequent 2 to 3 years has capital gains. The tribunal accepted this, said that because it is offered in the subsequent years, it is not taxable in the year in which the transfer had happened. These are 2 decisions in favor of the assessee, but there are 3 to 4 decisions against the assessee. This is Ajay Pulia's case, there is to be Sundaram Iyengar's case, Anurag Jain's case. All these decisions discuss the concept of transfer of capital asset in section 45. They say charge is in section 45, the computation is in 48. The charge in 45 is in the year of transfer. Just because there is hindrance in computation doesn't mean the charge fails. And the charge will always remain in the year of transfer. And it cannot be in the year of computation mechanism may be difficulty, but in the year of receipt, which is specifically given for enhanced compensation, has not been given for other different considerations, so it will be taxable in the year of transfers. So these are 2 different thought processes or interpretations which are possible. If you do the contrary decisions which are in favor of revenue, these decisions look more reasonable when you look at the language of the text of section 45. Because section 45 very clearly says it will be taxable in the year of transfer. Right? If you see this particular case, this has taken slightly different flavor, and that is why it is very important and useful, practically useful for the assessee. In this particular case, what happened is assessee sold the shares and had 2 components. One is the normal consideration, one is the deferred consideration. Assessee considered the deferred consideration and offered to tax in the year of transfer of capital asset itself. It did not defer it to the subsequent year. However, subsequently it got lesser amount. So let's take an example of simple 100 rupees and it was deferred consideration is 50. Instead of getting 50, it got 30 rupees. The assessment was already completed. The assessee filed application under section 264 to the Commissioner of Income Tax saying revise my order, and given that I have got only 30 rupees, I have not got 20 rupees, give me refund of that 20 rupees. So assessee took a slightly different path here. As usual, the Commissioner rejected the application saying that this is not permissible. Assessee filed a writ petition to Bombay High Court, and the High Court said that the only thing that is sacrosanct is that assessee can be asked to pay only such amount of tax which is legally due under the Act and nothing more. So what is due under the Act is 30 rupees in our example and not 50. So High Court said, yes, in this case assessee had offered 50, but now the deferred consideration is coming down to 30 rupees, and what can be taxed is that 30 rupees, not the entire 50 rupees. So though the assessee took a slightly different route from 264 to High Court writ petition, assessee got a favorable view. This approach to me looks more reasonable when compared to earlier approaches that it is either not taxable, taxable in subsequent years, or taxable entirely in the first year. Now, if you offer entire income in the first year, there could be a couple of things that one can take care. One, this decision can be used. If the assessment is done, 264 can be filed. Even if the assessment is not done and only intimation is passed, various decisions like Vijay Gupta's case, Delhi High Court, Kerala High Court have taken, and even for intimation 264, revision can be done. The assessee can take the benefit of these decisions, file a revision petition, and try to claim the refund for such amount. And given that the assessee would have really received a lesser amount, relying on this Dinesh Vadhrani's case, it will be a good case to get back the refund and reduce the capital gains consideration, and assessee can take it. If the assessee offers the deferred consideration in the subsequent years, there could be different challenges. Or you have to file multiple 264 for all the years so that it can be aggregated and that something can be done on those cases. Ideally, given that the transfer has happened and the capital gains can always be taxable in the year past. Second decision which I wanted to discuss is the Calcutta High Court on penny stock cases. This impacts not just penny stocks, but it is a very far-reaching decision which may impact various other kind of similar issues that the assessors face, like bogus purchases, dividend stripping, bonus stripping, and other sham transactions which could be there. This decision is also important because Calcutta was the place from where all this started. And in a batch of 90 appeals, the Calcutta High Court ruled in favor of revenue. The observation of the High Court will have a far reach. No doubt this matter will go to Supreme Court, but given the kind of situation the Supreme Court will be facing with this particular kind of cases, the question for the assessee will be very difficult. The issue for the assessee will be very difficult. This is a recent decision and looks at the batch of 90 appeals. The High Court first observation is the tribunal decisions do not discuss any facts in any of the cases. They say none of the 90 appeals discuss facts of a particular cases. They just follow some decision and have given their decision in favor of the assessee. So, if the penny stock cases where the tribunals blindly rely on some other decision and take a view in favor of the assessee, then this decision will make the life slightly difficult. Let's see highlighted that investigation. See, most of these cases are coming through investigation which has been done by DDID investigation in Kolkata, and he gave a report, and that report was used for cases. Some cases we have semi reports, etc., and all the cases were reopened. Another important point in all these cases is many of these cases were 263 revision by the commissioner. So 143.3 order, all the information was filed. 143.3 was passed. EO was satisfied with the assessee. For what reason he was satisfied, the EO knows, and he passes the order in favor of the assessee. The CIT revises those 263 orders. Under 263, all those orders, and the matter goes to the tribunal. Right? And tribunal had held in favor of the assessee, and then from there it travels to the High Court. So on the investigation report, see the general argument, legal arguments all of us have been making that I am not being given a copy of investigation report. I have not been given an opportunity to cross-examine the persons who have made those reports or who have made a statement with those reports and those particular purposes, etc. This is the arguments all of us have been taking in the tribunal. The High Court observes that investigation has not commenced from the point of an individual, and it has commenced with who dealt with the penny stocks, concept of working backwards. So this investigation started with who dealt with penny stock, with the companies, then the brokers. It is not dealing with a specific individual investor. There is anonymity of assessee. It is not specific to the assessee. The HCA held that no prejudice has been established to the assessee by not furnishing the investigation report in its entirety, nor making the person available for cross-examination. As admitted by the department in substantial number of cases, the assessee has not been specifically indicted by those persons for whom the statements have been recorded. So they might have recorded a statement of say 4 or 5 brokers. Those brokers never said this is the specific assessee with which I have dealt. Revenue accepts that. These statements do not say that these are the specific assessee for whom the penny stock transaction has undertaken. The entire report has not been given. Neither the person has been produced for cross-examination. One of the cases, or very many cases in the Bangalore trial like this, they said, okay, you have not given cross-examination, we send back the remand back the case, you give the cross-examination. But here the High Court didn't even think fit that cross-examination is required. They said cross-examination is not required. Even if those statements are not specific to the assessing, no problem. The investigation report is not given, no problem. Still we can do the AO is right in doing the assessment. Post-investigation, the concerned AO were informed to consider the bona fideness and genuineness of the claim of the respective assessing or the findings emanating from the investigation report. Now look at this. Unless and until the assessee shows and proves that he was prejudiced on account of non-availability, prejudiced on account of such report statements with mentioning of non-furnishing of report or non-availability of person for cross-examination, cannot vitiate the proceedings. The assessee has miserably failed to prove the test of prejudice or the test of fair hearing has not been satisfied in their individual cases. This goes again the concept of principle of natural justice, that if a statement is relied, the general understanding was that that statement should be furnished to the assessee and that person should be produced for cross-examination so that assessee can verify the genuineness of the statement and can question whether the statement is true or correct. If the certain statement is to be believed to be true without assessee having an opportunity to rebut it, that becomes very difficult, which is clearly against the principles of natural justice. The assessees are argued that reject this investigation report because it is a third-party report and not of the assessing officer. The High Court said it is a report of the internally of the department, so it cannot be rejected, it has to be accepted. So, High Court also relied on the Jain case and said that department can cause investigation when matters come to their notice showing abnormally high inflated claims of NDCG, especially when the share market in the country during the relevant period was not progressive. Therefore, no fault can be attributed to the IT department for causing an investigation, and any finding rendered pursuant to such investigation could very well be a material to commence further proceedings under the Act against the assessee who fall within the ring of suspicion. So very clearly, they said that investigation report itself is sufficient for reassessment or revision of those cases. So once we have a report and that report says that these are the shares of companies in which price rigging has been done, that report itself would be sufficient for them to reopen a reassessment of those cases. As we all know, even in the last set of reopenings, there are a huge number of cases of penny stocks and bogus purchases where this kind of reopening has been done. So from the revenues perspective, this case becomes shot in the arm for them. They will rely on this decision and say that all reassessments or all revisions under 263 are correct. This may also impact the demonetization cases where this kind of situation may arise. Again, the High Court observes that the report was in public domain. The revenue was able to show to the court that this report which was there was downloaded from the public domain, from the websites and given to the High Court. The High Court says when revenue is able to download from the public domain, the assessees also should have downloaded it. Why are they saying that revenue only should give me the report? They can easily download this report from the public domain, from the internet, and then you can use it. The HC observed that gathering of direct proof, you cannot gather direct proof of the meeting of minds of brokers or sub-brokers or middlemen or entry operator would be very difficult, and therefore the test to be applied is the test of preponderance of probabilities to ascertain as to whether there has been a violation of certain provisions of Income Tax Act. You do not require direct proof, you require test of probabilities, preponderance of probabilities. You apply that test, and if based on the circumstantial evidence, surrounding evidence, if it demonstrates that something is wrong, that is sufficient. Earlier, we always argued before the courts, and courts accepted that direct proof is necessary for me to assess or add such kind of income. Calcutta High Court has taken a view that this is not necessary, and surrounding circumstances, the test of preponderance of probability is sufficient in those cases. They say you can take note of immediate proximate facts and circumstances surrounding the events on which the charges allegations are founded so as to reach a reasonable conclusion. A test would be what is the inferential process that is reasonable and prudent man could apply to arrive at the conclusions. What a prudent man would apply to that circumstances would be sufficient. Because what we see in this kind of cases, that individuals who have never dealt in shares suddenly invest in one share, and in 1 year that share becomes 1500 times or 2000 times, right? So they clearly said this is not in normal how a normal prudent human being would behave. It is not within the human probabilities, and that is sufficient to assess this income as tainted income. That is sufficient to assess this income as tainted income. So they say that you should gather from various circumstances like volume of trade, period of persistence in trading in a particular script, particulars of buy and sell orders, volume thereof, proximity of time between the two, which are relevant factors, and thus methodology adopted by the department cannot be faulted. The test of genuinity needs to be established by the assessee. They say that assessee should demonstrate that this capital gains from penny stocks is genuine. The High Court said that assessee has not proved the genuineness of the claim. Creditworthiness of the company of which the shares were purchased, that creditworthiness was not established, and the identity of the person of whom the transactions were done has not been established by the assessee. So to tax under 68, 3 tests are applied: genuineness of the transaction, creditworthiness, and identity of the person. So that the assessee has not established these three, and therefore taxing this under section 68. And keep it in mind, post the demonetization amendment in 2016, 68 rate is 78%. The tax rate in this is 78%. So if you fall in this particular category, and if this High Court decision is upheld by the Supreme Court, straight away post December 2016, this income straight away taxable from EY 1718 onwards. This income suddenly become taxable at 78%, depending on the cess figure. It is 60 plus 15% surcharge plus 3 or 4% cess has been applicable for those years. So they say that assessee should prove that there is no price manipulation. It is for the assessee. The High Court observed that it is for the assessee to demonstrate that there is no price manipulation in a particular share. How can assessee prove? You have to justify with the balance sheet of those companies. Look, there were really something worth in this company that share prices went up. And if assessee is not able to demonstrate that the price movement was genuine and it was not rigged, in those cases section 68 applicable has been held. So the burden of proof is specifically cast on the assessee. The assessee needs to demonstrate that transaction was genuine. It needs to be demonstrated that price manipulation was not genuine. I mean, in the sense there was no price manipulation, it was the actual movement of price. So if the assessee is not able to demonstrate that it is an actual movement of price based on certain indicators which demonstrate that the share prices moves in such a parabase, other than in those cases, fine. If the assessee is not able to demonstrate those factors, in those cases, the Calcutta High Court's view is that it will not be possible to take them as long-term capital gains, which will be taxed as 60. Though one of the observations what High Court makes that you also need to prove the identity of the person who purchased it. That is not possible in a stock market transaction because you would really not have the who has purchased this. It is through an exchange mechanism. So to that extent, no doubt the High Court may not be correct. But if the High Court's burden of proof shifting on the assessee is taken in all penny stock cases which are currently before tribunal or other places, that is going to be very difficult for the assessee to demonstrate that really there was no manipulation in the prices. The burden of proof has been cast on the assessee that assessee should prove that there was no manipulation in the prices. Now, how will the assessee prove is going to be a challenge. In all these cases, the facts are such that you will not be able to prove that there was no price manipulation. Given that context, this case could be very important from the revenue's perspective. If it goes and confirmed in Supreme Court, then it has challenges for other kind of transactions also, like bill trading in GST, bogus purchases. Those cases also, or dividend stripping transactions, those cases also, this kind of a situation may arise. So this is the discussion on the Calcutta High Court. So with this, friends, I have completed my session on on taxation of shares and security. If there are any questions or any thoughts or inputs from the audience, I would be happy to take. And we thank you Bangalore branch for giving me the opportunity for me to share my views, and thank you everyone for patiently listening.
We'll break for 10 minutes and reassemble in 10 minutes. We have snacks and tea.
Hi, Mr. Narendra ji. I think we have come to the end of first excellent session. So I request our committee member, CP Jain, to hand over a momentum to our speaker as a token of gratitude and respect. Now moving towards our second session, income tax issues of JDA. I request our speaker, Mr. Bharath, Lakshminarayana, to take over the dais.
Good evening, one and all. Thank you, ICI Bangalore branch, the committee members, for giving me an opportunity to share my thoughts on this very interesting and dynamic but still age-old topic of taxation of joint development agreements, particularly the income tax dimensions. We've heard of joint development agreements. Just to give a quick summary how typically it works. There is this landowner who has a piece of land. He owns it alone or together with his family members. The land parcel is slightly big. It could be say a 60-40 site or close to 100-120 feet area. Or it would stretch up to about 2 acres, 3 acres, 10 acres, 15 acres. They do not have the wherewithal to develop a residential or commercial project on that property. So they enter into an arrangement with a developer who says, all right, I will construct a residential or commercial project on that property. I will give you a share of the residential units or commercial units, and I will keep some share of the residential or commercial units. And for that, I can also give you a non-refundable advance as soon as we enter into a JDA or as we start work. To that extent, what the landowner does is he permits the developer to enter that property and work on that piece of land towards the residential or commercial property. These are aspects which happen in substance and in reality. The underlying legal paperwork would typically start with a joint development agreement itself. And that joint development agreement for many years, this never used to be registered. So there was this concept of registration of the JDA or unregistered JDA. And whatever it is, the JDA would specifically permit the developer to enter the property. But many of the legal rights in respect of that land, would still be within the control of the owner. So the owner would still have the power to eject the developer from out of the property unless any other conditions were satisfied. Again, if we look at a residential project or a commercial project, it's a very large scale project. It starts with getting the plan approval, getting the approval of many local authorities, not only the local corporation but possibly the environment organization, the environment regulatory organization, the electricity board, the water supply authorities. There are many regulatory players who would play a role in that in the development of that residential or commercial property, and all of their approvals would be required for the project to proceed. And what the owner would say is only if you get all of these, they enter into the JDA with the condition that I will give you possession to develop that property once you get me all those approvals. Till then, I will not give you the right to entry into my property, but please give me a non-refundable advance or a refundable advance. Because I am giving you certain rights and authorities in respect of the property, such that the developer, if he is a larger, medium-sized player, so to say, he will say that we are launching this project in so and so area. This would be a say 50-flat apartment or a mixed-use project. It will have both residential and commercial, something like that. So, in that sense, even the developer would want to monetize from the arrangement from the word go. And here the question comes: how will the landowner be taxed? How will the developer be taxed? Right? And this started picking up good speed, at least from the past, say around 30 to 35 years, as urbanization spread fairly across the country, and large land parcels, which earlier used to be owned by individuals, could no longer be developed by them, and therefore they sought the help of organized real estate players or real estate developers. And like I said, this phenomenon started in the past 30 years, say from the early 90s across this country, and fairly restricted to the urban centers and the urban regions, so to say. So, for example, if it is Bangalore, the concept of JDA went as far as say Devanahalli in the north to say Kanakpura in the south, and towards Whitefield in the east, and for all you know, till outer stretches of the ring road close to the Mampi section. That's in Bangalore. Within Delhi, we saw Noida growing, not only the capital city of Delhi, but we had Gurgaon, Noida, Ghaziabad. All those agglomerations also developing simultaneously with Delhi. That entire section witnessed a surge, so to say, in joint development agreements. Similarly, Bombay, we had Navi Mumbai coming in, and Bombay expand significantly post the 90s. And that was when the concept of JDS came in. And that challenged some of the first principles of income taxation. So, like I said, the landowner. And what? Like we are aware of, income taxes income on accrual or arising of that income. What does accrual or arising mean? JDA is entered into. Whether mere signing of the JDA itself triggers a tax liability. These are the many questions from an income tax standpoint. Of course, service tax, VAT, and GST in the past few years. They have also deliberated on this issue, and initially the concept of JDS was fairly simple, like I mentioned. Thereafter, there have been many improvisations and fine-tunings to the concept of the JDA, which again challenge the notions of taxation, which is what we just go through today. And in the past couple of years, there have been significant rulings from high courts and the Supreme Court on which forces us to revisit our basics to try to fix this point of when will income tax be payable on a JDA or a real estate transaction. So we'll just walk through that. The broad scheme for the session for the next 75 minutes would be this. I'll just walk you through the basic framework and the legacy approach. Because in 2017, the law on taxation of income from JDS, particularly for the landowners, has undergone significant change, a very important change, and that is where the focus of my discussion for the next 60 minutes will be. So, like I said, this has been a complex and constantly evolving area in income tax, and no matter how many amendments are made into this whole idea, there will be new issues which will crop up. So, even the new provisions, while they are very favorable to a landowner, there are many other nitty-gritties which we as practitioners will definitely encounter in our day-to-day life. So, let's go through that. Finally, the issues primarily involved, like Narendra was mentioning earlier on taxation of shares and securities. Even with taxation of JDS, the issue primarily involves on characterization of the asset. Whether the subject matter is stock in trade, whether the subject matter is a capital asset involving land or building. Because, for example, if the landowner owns multiple parcels of land, say he owns about 50 to 60 acres of land, and he hands out the 50-60 acres over a period of say 5 years or over the period of 7-8 years to about 10 to 20 people, 10 to 20 developers. Alright? Then would you call that piece of land which he owns, the land parcels which he owns, as stock in trade, or would you call them as capital assets? Alright? So the essential issue starts from there. How do you call out the asset which the landowner owns? Will you call it out as stock in trade, or will you call it out as a capital asset? Because for all you know, assuming for a moment that the landowner has been very compliant, he keeps his books of accounts or at least a set of statement of affairs. For all you know, that land would be appearing under the head of investment. For all you know. Correct? He may not have had any desire, so to say, to sell it over a period of time to say 10 to 15 developers. He may not have had that intention. He may have wanted to just keep it with him, and therefore he would have called it as an investment. Alright? But then circumstances have changed. He's decided to move on, and therefore he's farmed it out, so to say, to many developers to develop it. Does the characterization of that asset change from a capital asset to a stock in trade? Because again, why stock in trade? Why stock in trade is simply because whether we want to assess that income as capital gain income or business income. Again, to classify something as business income, the income should emerge from a business. What is a business? Any trade, commerce, manufacture or adventure in the nature of trade, commerce or plan. Right? And what does a business postulate? A business postulates that there should be some continuity and systematicity in the process of earning income. It should be something systematic. So now let's take this simple example of this developer, this landowner who has about 50-60 acres, and he's given it out to 10-20 developers. Right? Can you say that his activity is systematic and continuous because he spread it out over 6 years? Or will you still call it out as a capital asset because he's had it as investment in his books? Right? Again, now why does this matter? This matters because finally the income for that landowner would finally be business income, and are there restrictions on the amount of expenses which he can offset against that income? Right? Assume for the moment he has losses. He is permitted to set off or to carry forward those losses only for a period of 8 years. To the extent obviously it relates to business loss and not the others of depreciation. There is a limit of 8 years, there is a limit on the nature or kind of expenses which you can claim. On the other hand, if you switch it over to capital gain, alright, you will have the full value of consideration on the one side. There are restrictions on the way you identify cost of acquisition. Most importantly, if there is a capital loss, there is no time limit up to which you can offset it. You have 8 years in the case of business income, but there is no time limit for capital losses. Right? And also, you have this very important concept of indexation which is available in capital gains but not in business income. Right? So, if you were to assess the same income as business, income from business, you will never get that indexation benefit. Right? That's why this characterization issue itself becomes very critical. circulars like Narendra mentioned in the context of stocks and securities. In the context of land transactions, we have a whole host of rulings of the Supreme Court which lay down principles. Alright, but none in the context of this issue of the simple example which I gave, where this guy owns, this landowner owns around 50-60 acres and he's leased it out again and he sold it to developers over a period of 6 years. In those facts, there are no rulings even to this day. So it's a very open field. It comes across, it comes to first principles. The department itself has been taking vacillating stands. In certain cases, it says this income, for example, if an assessee claims that it is capital gains income, the department turns around and says, no, what you are doing is an adventure in the nature of a trade, commerce or manufacture. A single or isolated transaction also comes within the purview of business income. Therefore, we will tax this as business income. Right? And this is generally the feature. These issues are identified particularly in the revisionary proceedings, and we've had many tribunals holding that on this issue the department itself has not made up its mind, and this is a fairly debatable issue, right? And there are no second principles of right or wrong on this because it varies from fact to fact, and the fact that at the stage, at the initial stage, the assessing officer made up his mind that this is capital gain income, that shouldn't be subject to a revisionary proceeding. So we've had a slew of rulings on that part. We've had cases where they were simply agriculturists, and those agriculturists converted their land into plots and sold it. Right? How do you classify this? Would you call this as capital gain, stock in trade? What would you do? Again, there were those issues of whether that agricultural land was in need of agricultural, so that the transfer thereof did not trigger any income tax, or the fact that he converted it for non-agricultural purposes. Does that bring it into the ambit of income tax? Right? There are all these niceties which do generally come up, and many of these flavors boil down to these two simple issues. Next, whether there is a transfer as per the Income Tax Act. Right? With a JDA, like I mentioned, the landowner keeps substantial legal rights. He permits the developer to enter into the property and develop that property. Would this constitute transfer? The landowner has also got a non-refundable deposit. The landowner has got a non-refundable deposit after entering into the agreement. Would that be a capital sum liable to capital gains tax in the year of receipt? Or would we have to wait for some time? What is relevant? Have the conditions in section 2 clause 47 on transfer been satisfied? There has been a host of litigation on this, and the Supreme Court a couple of years back has really enlightened all of us on the whole concept of part performance, which I just made a little time later. But whether something is a transfer itself in the context of the JDA is a very debatable thing. It depends on each joint development agreement you see and read. Right? Each clause in that joint development agreement becomes very relevant. Not only the joint development agreement in form, but also on the field, what has happened. How has the developer acted pursuant to the JDA? Have approvals come in? Right? Has the developer started the work? Has the developer completed the activity? For whatever reason, has the JDA seen its full course, or has it been terminated for whatever reason? All these aspects, alright, are relevant in this subject matter. Having said that, one other crucial part again on this part of transfer which we discuss in some time is let's take a simple example of a sale of shares which Narendra was talking about. We sell shares, we are very clear that there has been a transfer. The buyer takes the shares and he moves on. With JDAs, the facts are not so simple. Until a residential unit or a commercial unit is, so to say, handed over to the landowner, right? The landowner still retains that connection, legal and factual, connection with the property. Right? So they entered into the JDA 2020, but the residential unit may be handed over to the landowner in 2032. Contrast this with sale of shares, sale of securities. The transfers happen within a blink of an eye. Right? So fixing that date of transfer, year of transfer is relatively easy with assets like shares and securities. But with the concepts of land, because of the very nature of that asset, fixing the time also becomes very difficult. Right? That is this issue which I was mentioning. Again, what is the sale consideration? Right? With stocks and shares, issues are fairly simple. The sale consideration is fairly fixed. In business deals, which Narendra was mentioning, there could be a case of deferred consideration. And the issue only becomes at what point in time, when will be, when is that consideration has crystallized, and at what point in time it has crystallized. Fairly simple. But with JDS, the issue is also on what is the sale consideration. Right? So 2020 they entered into the JDA. The consideration is set 2 crore of non-refundable deposit plus say about 10 apartments. Alright? Now, how will we identify the? Let's assume for a moment that we said that there has been a transfer in 2020 itself. Let's assume for a moment. Right? Now, how do we identify the sale consideration? We are supposed to file our returns, and when we open the income tax computation and want to fill out value of sale consideration, how will we identify that value? Because full value of consideration, as the Supreme Court has said in many rulings, is the actual value which is received by the transfer. Now here what's happened? The transferor has received, the so-called transferor has received this non-refundable deposit of whatever 1 crore, but he is also eligible for flats, residential apartments of say some 7, 10, 15, whatever. How do we value those flats? Do we take the valuation today? We are clear that yes, that non-refundable deposit is surely income, alright? But what about the flats? How will we value them? We hit a dead. And there was a lot of discussion and debate on this issue of what is the sale consideration itself. Right? Such that as of now, the matters are still with the High Courts. They have still not travelled to the Supreme Courts. The Karnataka High Court, for example, in CPC Logistics and Sarojini Kushe, both of these are 2021, 2022 rulings of the Karnataka High Court, where they said, in the absence of guidance, it's the stamp duty value which has to be considered. Alright, again, these are post 2012, 2013 rulings. Now the real question is, what about rulings before that? Alright? In the rulings before that, there has been a set of mixed views. So for example, in the case of NS Nagaraj, what was considered as sale consideration was the cost of construction. So in that case, there was a non-refundable deposit, there were also apartment units which were received. So there, the assessing officer mentioned that it is the cost of construction which is the sale consideration. Look at the travesty. When we transfer something, we should be taxed on this whole concept of real income. Right? The real income theory underlies the income tax. Right? The Income Tax Act in specific instances has been modified to overcome the real income theory. It starts with the house property income. Wherever so-called deeming fictions are used to deem something as income, those are the overriding of the real income theory, because the law is very clear that it's only real tangible income which is to be taxed and not notional incomes, unless the law calls out for it. Right? Here, and the Supreme Court, particularly in the context of sale consideration capital gains, is very clear that what the assessee has received is what is to be considered as the full value of consideration. And in the context of JDS, we have had this peculiar situation of notional items being taxed as income. Right? That's the peculiarity of this. And in CPC Logistics and Sarojini Kushe, the appraised on this ruling of the Bangalore and again in NS Narendra, which says that cost of construction is the same full value of consideration. The High Court said no, that is not a proposition which we will accept. Unfortunately, there is no reasoning from the Karnataka High Court on why it should not be considered, because in NS Narendра's case itself, there is a very elaborate discussion on why cost of consideration should be considered as against the stamp duty value or weighted value. NS Narendra was one of the earliest rulings on this matter, and it has deliberated this issue fairly well. Right? Unfortunately, the Karnataka High Court has not explained as to why we should prefer the stamp duty value as against the cost of construction.
Stamp duty value for price.
Other facts, weighted value of facts. Again, thereafter comes the next question of what is the cost of acquisition? Right? Assume for a moment we sell the land and we enter into the JDA. We've got this we've got this non-refundable deposit and the flats. And the question comes, what is the cost of acquisition for that? Right? Because subsequently, when these flats come, we sell the flats subsequently. Right? Let's take some dates. 2020 we enter into the JDA. We have got this non-refundable advance, and then we are eligible for 7 flats. In 2028, we get those flats and we sell those flats in 2030. Right? So if you see, there are multiple stages where we earn incomes. How will we identify the cost of acquisition for each of these steps? That also becomes difficult. That also is subject to litigation. Right? Those are the final aspects in the issue of JDs. At every step of the capital gain computation, we have issues. Right? So again, finally, like I mentioned earlier, all of this becomes relevant to identify what is the quantum of income which is liable to be taxed. A business income characterization has an impact on the total income which gets taxed. The capital gain characterization has a different impact. Again, of course, the tax rate, the surcharge rates, all of this will vary. Right? For today's discussion, I have restricted my approach only to looking at the implications for landowners. Right? For developers, I will just spend very brief moments, because with the developers the issue is fairly simple. They operate by way of private limited companies or registered entities. Objects are set, and it is fairly easy to call out the income from development of land parcel as business income. Right? From sale of flats, sale of commercial units. However, rental of commercial units, rental of flats takes a different cue altogether, because then there the fight is between whether that rental income is house property income or business income. And on this, the dust has not settled to this day. Right? From Sultan Brothers to Royal Enterprises, right? To the other Supreme Court ruling, I think, which came from Madras High Court, it's still 50-50. Because one of the Supreme Court rulings says the MOI is very relevant to determine whether it is business income or house property income. Another subsequent ruling says no, the MOI is not really relevant. Right? So the dust has not settled on whether rental income is business income or house property income. Again, here there is a play. With house property income, calling it out as house property income makes a lot of sense, where the quantum of expenses which can be claimed, alright, are very, very low. Because in house property income we get at least a 30% standard deduction. Right? But with calling out something as business income, there is no limit to the amount of expenses which you can claim, so long as you connect it to the activity of earning that rental income. Right? So one is the rental income versus business income characterization. Right? And the other is income recognition for the developer himself. Right? How is income recognized for that particular developer? Pre-ICDS, the issue was fairly evenly poised. Many developers used to adopt either the percentage completion method of accounting or the project completion method of accounting. And both were well accepted by the courts. Although the department was very insistent on the percentage method of percentage completion method because it gave the department annual revenue based on the development of the project. Whereas with project completion method, in reality, many projects never got completed, so the developers never offered all those incomes, although they kept advance from customers in their balance sheets. So the department used to go behind developers who used to offer income under the project completion method, right? But there were a host of rulings from tribunals saying that as long as the project completion method has been consistently followed by the taxpayer, that should be respected, that should not be disturbed, and that is a very legitimate approach of offering income to tax. And wherever percentage completion method was consistently adopted by the taxpayers, that was also affirmed as a valid approach. Again, if we go back to our first principles of the real income theory and apply to the percentage completion method, if you see on a percentage, say which a chartered engineer could give, say 35% of the project is complete, we need to offer income. Whereas on the advances which we receive from our customers, we still have a liability. We still can't call their advances as our income in reality. And even in legal terms, we can't say that that is our income. Because in the balance sheet we are calling them as advance. Alright? But the percentage method of the percentage completion method forces us to offer something to tax. Alright? Again, the accounting principles come there to push a person to offer something as under the percentage completion method of fairness and those first principles of accounting. But when you juxtapose it with the income tax principles of real income, percentage completion and real income are far away. Okay? Those are the other final aspects. But after ICDS, it's a mandate for all developers, whether individual, company, partnership, etc., to offer their income based on the percentage completion method because the ICDS on revenue recognition specifically requires us to do so. Right? Again, now taxpayers can still take that lead. Right? That ICDS cannot override the real income theory. Right? But fortunately, many developers have accommodated themselves to that reality that they have to offer income by way of the percentage completion method and not by way of the project completion method. So that is on that again the only issue which comes up again is on the quantum of percentage complete, especially for non-corporates. If individuals are offering incomes based on the percentage completion method, the income tax department typically comes up and says, you said that based on the chartered engineer's report that it is 15% of the project which is completed, but I believe that something higher has already been completed. Alright, and they send out their inspectors for a survey, they refer it to the district valuation officers as the case to be, identify a higher number. This is going to be the norm. There's not going to be any certainty on this, and we just have to hope that better wisdom prevails both for taxpayers as well as the income tax department. That whenever a percentage completion method is adopted, the basis for arriving at a certain percentage is fairly firm. It stands on firm ground. The backing, the workings for that are very clear and very easily demonstrable. That is something which we have to only expect taxpayers to keep and the department to respect all of that. Those are the issues which typically apply to developers. That's why I have not chosen to spend much time there. Instead, we go to this, the issue we'll concentrate this evening on taxation of the landowners only. Right? Now, like I mentioned initially, the basic framework in these concepts would be a landowner owning land. The land would be in an urban area, agricultural land. So, what is urban area has been a matter of debate. What is agricultural land has been a matter of debate. Right? Especially in urban centers, when the municipal limits are being extended significantly. Alright? What was agricultural land in an urban area is no longer agricultural land in the real sense. Right? For example, we had this one day when I was in the tribunal, there was this matter which was being argued. A land parcel situated on the Mysore Road, Bangalore Mysore Road was sold. fetched a huge amount. The assessee was claiming that it is agricultural land outside the purview of taxation. While the 8 kilometer municipality, 8 kilometer limit, all of that was not satisfied. Strictly speaking, while it was agricultural land, the tribunal members jokingly mentioned, we believe that the entire stretch of Bangalore to Mysore Road is an urban area. You cannot call any stretch from Bangalore to Mysore as an agricultural area. And that's the reality. If all of us staying in Bangalore will be able to relate to that, and I'm sure this would be the case also with say say Mumbai, Hyderabad, Chennai, Delhi as well. Fortunately, the parameters on this are fairly clear. It's been etched in law. Agricultural land is very well defined in the Income Tax Act. The only important point is how good documentation are we able to get that they are outside the municipal limits. Because every now and then we've seen the governments establish new municipal centers. Say for example, Bangalore, we had Bangalore Urban District, Bangalore Rural District. Then Bangalore, some part of Bangalore Rural was carved out as Ramnagar District. Right? And within the Ramnagar municipality, an 8 kilometer zone came out. Such that within, if it was Bangalore Rural, they would have been agricultural lands. But because of the Ramnagar notification, they did not become agricultural lands. Right? So that is the only point of point which practitioners should insist with clients, that we get clarity on whether that is agricultural land as per the Income Tax Act. Right? That is something which we need to seriously and closely track. With urban lands, again one common issue which comes up is the piece of land may be in Vijayanagar. Alright, the land is right on the Vijayanagar main road. The guidance value could be say 10,000. Alright, the same period, a similar area of land down the road in Vijayanagar, say it abuts Rajapalli or a drainage. The guidance value of that property would be definitely lower. In reality, what it would fetch in the market would definitely be lower. The developer who develops the apartments on such kind of land would definitely be earning a lower return compared to if he develops that same property on the main road. Right? Now, again, this whole concept of stamp duty value, guidance value, market value, all of that assumes importance. Because if we apply this benchmark of guidance value across, it doesn't make a distinction between a land which abuts a drainage and a land which is sitting on the main road, which does make a big difference in some cases. Right? That is the critical dimension on tracking this whole concept of urban land, rural land, agricultural land. And then after the landowner, there is this developer with the capability to construct residential or commercial units. Characterization of income in the hands of the landowner, like I gave you the example of this landowner who owns 40 to 50 acres of land and he farms it out over a period of 5 to 6 years. Right? Characterization of income in the hands of the developer we discussed. Yeah. So with that we go to the legacy approach. Right? The legacy approach was, like I was mentioning, transfer in relation to capital asset. What does it include? In the context of JDAs, I just listed down which are the relevant clauses in section 247 which are given. Sale, exchange or relinquishment of any asset, extinguishment of any rights therein, any transaction involving the allowing of the possession of any movable property to be taken or retained in part performance of a contract of the nature referred to in section 53A of the Transfer of Property Act of 1882. This was born of contention in the context of JDAs. The reading of this provision was the bone of contention all these years. And as a recourse, if not this, then this residuary, so-called residuary clause would be invoked to seek to tax this transaction. Any transaction which has the effect of transferring or enabling enjoyment of any immovable property. Just visualize that example. There's this landowner who says, I have all the legal rights. I will allow you to occupy that land and construct a property. If we see it in the plain reading, if you read simple plain English, it could get covered under both these clauses. Any transaction under 53 of the quota, any transaction which has the effect of transferring or enabling enjoyment of any more property. That's how both taxpayers and the income tax department used to generally read it. Right? Because once I enter into a JDA, I enable this developer to have possession of the property. Right? And we used to say, yes, this is a taxable transaction. On a conservative note, let's offer the guidance value to tax. Let's claim the cost of acquisition, whatever it is, whatever nominal amount it could be, and let's move on. Right? But then there are peculiar instances, right, which I discussed in a short way, which shook that kind of understanding which we had. Explanation 1. Immovable property shall have a meaning per section 269 UA clause D. 269 UA clause D is virtually a dead set of provisions today. But in the context of immovable property, the definition is extremely unique in 269 UA that it not only taxes real, it not only considers real immovable property as immovable property, it also says rights in an immovable property also constitute immovable property. Alright? And the premise was that when we enter into a JDA, we are giving possessory rights in the property to the developer. Right? Therefore, that is a transfer of an immovable property, and therefore it is liable to capital gains. Right? What we used to say was, when we enter into a JDA, we give the possessory rights to the developer, and therefore there is an immovable property which has been transferred. Right? And therefore there has been there is a capital gains tax liability. The Supreme Court in Balbir Mining and Sheshwai Estates has made us revisit this view. We will come back to that again shortly later. Right? But the
power of attorney also makes it as transfer.
Yes. So all of that discussion was there. On power of attorney, the Supreme Court in Surajland, I think in about 2041 idea, in around 2012, clarified that power of attorney sales are not sales. We do not legally recognize that power of attorney sales are sales. This got settled in 2012. So till then, yes, this was a valid. So transfers used to happen extensively in the northern parts of India. It used to be a fairly normal kind of a transaction. Here at least we used to have something called JDAs, and it used to be on stronger legal ground in the southern and western parts of the country. But in the northern and eastern parts of the country, the norm was a power of attorney sale. And in Surajland courts, the Supreme Court simply de-recognized all those POA transactions. Please don't ask me what happened to the title holders there, right? Because Surajland courts disturbed, unsettled, or ruffled a lot of others. Right? Yeah. Having said that, in the context of JDAs, it is this section of any transaction involving the allowing of the possession of any immovable property, part performance. Basically, the clause of part performance is what is primarily invoked. Because what is this whole concept of part performance? In layman terms, as we all understood all these years, is what I will explain. And I will later on explain how the Supreme Court said this should be understood. Right? We enter into a JDA. The landowner says, I will retain a lot of rights, I will give you possessory rights. He is doing this in part performance of his agreement to sell this property at a later stage. This landowner, he is partly performing the contract by allowing the developer to enter his land and develop the apartment units or the commercial units. Therefore, there is a part performance. The part performance is in fact, INFACT, is in fact, right? This is what the Supreme Court said, no. You should not look at part performance whether it is happening in fact. You should see whether part performance is happening in law. That is what this clause mentions. That is what 53A of the Transfer of Property Act says. Was what the Supreme Court said in Balbir Singh Mining and clarified that further in Sheshwai Estates. Alright? So, merely allowing this developer to enter into my is not part of it. Right? What? According to the Supreme Court in releasing money, there should be many more rights attached to ownership which should migrate from the landowner to the developer. Thereafter, the developer should have possessory rights. He should have possessory rights in law. Right? And how do you have possessory rights in law? You will have possessory rights in law when you have some of the ownership rights associated with that property. Only then will you, in law, satisfy the condition of 53A of the transfer of property. Again, this concept of 247 was introduced again in effective AY 88-89 because as the memorandum to that amendment read, to plug the loophole that taxpayers used to enter into agreements for developing properties with the builders, and under the agreement with the builders they used to confer privileges of ownership without executing conveyance. Right? Conveyance is basically a legal document, right? As something like a JDA, etc. Right? So that was how this was read. As if you enter into a JDA, you automatically satisfy this condition, and therefore what you are doing is transfer. That is how it was understood. Right? And again, in Securities, which came from the Bombay High Court, way back in 2003, the Supreme Court had laid down certain principles, but it did not dwell upon this concept of part performance, etc. What did it say? It said there should be a contract for consideration. Our JDS, our typical JDS, satisfied as it should be in writing, satisfied. It should be signed by the transfer, satisfied. It should pertain to transfer of immovable property, done. Transferee should have taken possession of the property, done. Right? Transferee should be ready and willing to perform his part of the contract. Right? This was also followed by the Karnataka High Court in T.K. Dayalu's case, where the taxpayers sought to offer to tax their own. This is a 2012 ruling of the Karnataka High Court. The facts in T.K. Dayalu's case pertain to the year 1995-96. Right? So we have this Freedom Park, right? All of us are familiar with the Freedom Park. Just opposite the Freedom Park, there was this fairly 180 by 200 piece of land which housed the Bangalore nursing home in earlier days, which was owned by Dr. T.K. Dayalu, and he sold it to a developer. That was one of the first properties in the city area to go under a JDA way back in 95-96, and that was a subject matter of discussion there. And then the taxpayer had adopted this position that by entering into a JDA, I have not earned anything. I have not earned anything on entering into the JDA. I have earned money only on completion of the construction, right? Which is a subsequent year. Whereas the assessing officer is seeking to tax me just by me entering into the JDA, right? That is where the Karnataka High Court said no. There is the Supreme Court ruling in Securities Kapadia. You satisfy all the conditions therein. Therefore, the year of entering into the JDA, particularly the fact that you have enabled the developer to enter into the property, you have given him that possessory right, that triggers a transfer. Therefore, the JDA, year of entering into the JDA becomes the year of taxation. That was what the Karnataka High Court told in 2012, which was mostly followed across the country, and the legal position seemed to be settled on this. Right? Thereafter, I come to Bharath mining later on. Right? Adopting what was laid down by Securities and T.K. Dayalu, all of us, all practitioners started adopting this two-stage taxation of capital gains. In the context of JDAs, we call this a two-stage taxation. What is the first stage? Upon entering into a registered JDA with possessory rights in property for the developer. Right? As long as possession was handed over to the developer, we used to tell the landowner, boss, you have to pay capital gains tax. Alright? And then some practitioners used to adopt the view that cost of construction should be taken as same consideration. Some people used to adopt the view that fair market value of the flats which you are going to get on the date of the JDA is the same consideration. Right? Which was fairly equitable. If we see this, we will understand that it's fairly equitable. First stage is that. Second stage is upon sale of flats or units to the end user, end customer. Alright? In this situation, what used to happen? Whatever the landowner would get flats. Those flats would be sold to people. That would be taken as the sale consideration. The cost of acquisition would be that sale consideration in the first stage. The first stage sale consideration will be the second stage cost of acquisition. So all in all, from an economic standpoint, there is no loss to the revenue. Right? The difficulties were many practitioners were not convinced in the fact that the fair market value or guidance value or cost of construction should be considered as the sale consideration, because it strictly does not satisfy the definition of full value of consideration as per the Supreme Court saying George. Right? So there was this sort of a set of mixed feelings with practitioners on what the sale consideration should be, which obviously used to get carried to the cost of acquisition in the second stage. And many landowners used to shy away from this scheme because assume for a moment, say 50 acres of land, let's take that example. 10 acres are given to one developer to develop, say, 500 flats, of which 100 flats would come to the developer. Alright? And what has the developer, 100 flats would come to the landowner. What would the landowner get? The landowner would get one non-refundable deposit. Alright? And he would get, and that's it, in cash, that's all that he's got. Alright? But if we were to work out the capital gains tax, we had to identify the stamp duty value of 100 flats. Take cost of acquisition, arrive at capital gains. 20% of that. The landowner never had that money to pay the tax. That was the biggest difficulty with this two-stage process. But the department was very clear, Karnataka High Court was very clear. These final aspects they never realized. That means you say it's applicable on guidance value, but then where will the landowner have the money to discharge even the capital gains tax liability? Right? That was the challenge. But many practitioners convinced their players that this is the only approach, else they will be in trouble. And slowly around 2014-15, the coordination between the district sub-registrar offices and the income tax department became very close, such that information used to move from the district registrar to the income tax department, and the income tax department started issuing notices, conducting surveys, conducting searches on these landowners, and therefore this approach of two-stage taxation came to be fairly accepted in the market. Right? Despite the difficulty. These were the difficulties which I mentioned. Right? The biggest challenge was, what if the JDA is terminated before the completion of the contract? The landowner has discharged his liability by following the first stage, second stage approach. The JDA itself is terminated because some approvals he did not get, those 100 flats which he was supposed to get never came. But he paid 10 crore in capital gains tax in year one. One of the biggest difficulties. And the case study for this is Balbir Singh Maini, on which the Supreme Court came out with its ruling a few years back. This was the precise point which the Supreme Court said vitiates this whole concept of mere possession triggering transfer. And there, what had happened in Balbir Singh Maini's case, 3 installments were paid to the sellers, landowners, but then the developer could not get approvals within time. Alright, he could not get those approvals within time, and actually in Balbir Singh Maini's case, on the 3 tranches of money which the landowners had got, they had actually offered that to tax. Right? And then finally, the JDA got terminated. Right? And what the assessing officer said was, the fair value of the entire project should be taxed in the year of the JDA. The same thing based on the Tapadia and TK Dayalu was applied by the AO. And he said, nothing doing, you entered into the JDA as a taxable event. The taxpayer said, was the entire JDA is collapsed. So, the land has reverted back to me. There has been no transfer. I paid tax, yes. Unfortunately, the ruling does not discuss what happened to the tax which these days I paid. Right? The RCC said the land is still with me. There has been no transfer, which is what was acknowledged by the High Court and thereafter the Supreme Court when it said you have to pass on legal rights in the property to the developer. Only then will you satisfy 53A. Only then will there be a transfer. So this principle in Chaturvedi Dwarkada's Kapadia that the parties should demonstrate the intention to satisfy the terms of the JDA, not very relevant. The Supreme Court has now clarified that very well, saying that significant rights should move. And only when significant rights move, that is when there is a transfer. Alright? Similarly, in Securities, there was a JDA which was entered into, and that JDA never materialized, etc. Finally, there was a compromise memo which was signed by the landowner and the developer. That is, the landowner got some money and it was left at that. The landowner did not offer even a rupee to tax in Securities case. He did not offer even a rupee to tax. What the department said was, the year you entered into the compromise petition with the developer and you got some money, that is the year of transfer. And therefore, and in that particular case, under that compromise deed, land was in fact transferred. Right? What the taxpayer said when the department said that the year of the compromise petition is when there is a transfer, the assessee turned back and said, hey look, I entered into a JDA many years back. You should have taxed me in that year. In that particular case, that was beyond the period of limitation. So the assessee knew very well that the year can't do anything. He took that plea. Correct? To which the Supreme Court turned around and said, no. The year you entered into the JDS, significant rights were with you. In the year you entered into that memo of compromise is when you in fact actually transferred the property to the developer. And it is not any case of part possession and clause 5 and 6. It's nothing of that kind. It is simply an extinguishment of your rights under clause 2 of 247. Forget part performance JDA, please don't bring those concepts. You extinguished your rights in the property. And therefore, what the department has done is it. So, the Supreme Court underlined this concept that when substantial rights in that property have moved on to the developer, is when there is a transfer. Right, so today, as of today, we still cannot give a decisive view on when is the year of taxation in the case of a JD, because we need to see the JD. Right, because there are so many principles which the Supreme Court has laid down in Balkis mining. And Securities is a fairly cryptic ruling of the Supreme Court. We need to see the tribunal ruling which has many more facts to identify what made the Supreme Court say whatever it says in Securities. Right, so now we were better off, so to say. We are better off without Balkis mining and Securities. After these two rulings, this issue of the point of taxation of a JDA has become even more critical. Right? So today, frankly, there is no definite or decisive answer on what is the point of taxation of when a landowner enters into a JDA. Right? In the midst of all of this, I would call drama on this matter, the government finally introduced section 45. Right? What it said was it understood the difficulties of paying tax on the guidance value in the year of the JDA when the assessee has no money. It addressed that issue and it said, when the taxation trigger happens in the year of the JDA, it doesn't say that, you go through it later, it doesn't say that. The taxation is deferred to the year in which you receive the certificate of completion. So the point is shifted to the year of certificate of completion. So we just go through that. There are minor nuances, and with that I just quickly wrap up because we are watching time stuff. It was introduced by the Finance Act effective FY 1780. Statements in the memorandum, they extend scheme of taxation. So this is the mind of the government on taxation of JDA. The government had never made clear clarified what its stance was on JDA taxation. In the memorandum to the Finance Bill 2017, it said what it was. Execution of JDA between the owner of immovable property and the developer triggers the capital gains tax. This was again before purchasing money and shares. Before purchasing money and shares, the government clarified, it adopted the principles of Charterization, Kapadia and TK and said execution of the JDA triggers the capital gains liability in the hands of the owner in the year in which the possession is granted to the Charterization, Kapadia and TK acknowledged. Context of the amendment, with a view to minimize genuine hardship which the owner of land may face in paying capital gains in the year of transfer, we are introducing these provisions. They address this limited aspect. Alright? You just have to wait and watch the government's reaction and positions which evolve out of releasing money and shares statistics. Right? Whether they make an amendment there, you just have to wait and watch. Let's go to this. For individual or HF who enters into a specified agreement for development of a project, the capital gain shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. Right? So the year of transfer remains the year of the JDA. Right? When should we charge capital gains tax and pay it is postponed. Right? Postponed to which year? To the year in which we receive the completion certificate. Right? So this is the section as it reads, notwithstanding anything contained in section 45, where the capital gain arises to necessity, being an individual or HUF from the transfer of capital asset, being land or building or both, under a specified agreement, capital gain shall be chargeable to income taxes income of the previous year, which is the rate of completion of the whole or part of the project is issued by the competent authority. For the purpose of section 48, alright. So now first it identifies the time, alright. Then it also clarifies what is the sale consideration which has to be, which is the full value of consideration. It says for the purpose of section 48, the stamp duty value on the date of issue of the said certificate of his share, being land or building or both, as increased by the consideration received in cash, if any, shall be deemed to be the full value of the consideration received or accruing as a result of the transfer of capital asset. Right? So now it decisively says that the stamp duty value, right, on the date of issue of the certificate of completion. Stamp duty value as on the date of certificate of completion, as on the date of issue of certificate of completion would be the full value of consideration. Right? It shall be deemed to be the full value. Right? Because it acknowledges that in reality that will not be the consideration. That is why it deems. Right? Now whether it is good and bad, it's made life definitely simpler, but those examples which I gave, property situated on the main road versus property situated down the road next to a drainage area, fire sales, right? Because of some emergency, the landowner says, I will sell it right away at 30% discount to the stamp duty. Right? These exceptional circumstances are still legion. Right? In those exceptional circumstances, we will appreciate the difficulty imposed by this provision. Right? Otherwise, it has clarified the legal position very well. In that sense, that genuine difficulty is in fact addressed because it postpones the capital gains tax payment to the year in which the landowner actually has that money. Right? Because typically the assumption is, as and when they receive the completion certificate, by that time they would have gathered the buyers and they will have sold that property and they will have that sufficient liquidity to discharge the capital gains tax. Provided there is this very interesting proviso, right? Which if the proviso gets triggered, the old stories again get revived. Right? Provided that this section, subsection shall not apply where assessee transfers his share in the project on or before the date of issue of the said certificate of completion, and the capital gain shall be deemed to be the income of the previous year in which such transfer takes place. And the provisions of this Act, other than the provisions of this subsection, shall apply for the purpose of determining the full value of consideration received or accruing as a result of such transfer. Right? Let's and then thereafter. So there is that clause subsection 5A. There is a proviso. Beneath the proviso, there are three explanations. One is competent authority. Competent authority means the authority empowered to approve the building plan by or under any law for the time being in force. Right? So, for example, if we have the PMRDA, right, or BIAPA, are they competent authorities? Right? We have to go to their enacting laws to understand whether they are the competent authorities. Right? Assume they are not the competent authorities. What do we do? We go back to limbo. They are not sure. Right? Anyways, but this is definitely good clarification because exceptions will always be there. Right? And like Murphy's law operates, it is the exceptions which we generally deal with. Right? Specified agreement means the registered agreement, right? Please note this because one of the important points in Balbir Singh mining was also that it was an unregistered agreement which was there. Right? And the Supreme Court clearly said, after the amendment to the Registration Act of 1908 in 2001, it is important that an agreement to become enforceable in court should be registered. Unregistered JDAs have no sanctity in law, even for income tax purposes. So, if you in fact earn money out of an unregistered JDA, it was still outside the purview of tax. Right? But those are all academic points because in reality people would register those contracts because real estate is a very dicey area and enforcement is a critical, civil court enforcement is an important dimension in real estate transactions. So, a registered agreement is the ask here, in which a person owning land or building or work agrees to allow another person to develop. So, they have defined the JDA. What a JDA is what is defined in this explanation. Agrees to allow another person to develop a real estate project on such land or building or both, in consideration of a share being land or building or the such project, whether with or without payment of part of the consideration in cash, full stop. Right? So, the way they have envisaged JDS in this explanation is that the consideration will surely emerge by way of a share in that project. So, the question comes, what if I do not get any share? I get everything in cash or through bank. In this figure. Right? We do not know. I mean, it could be an academic question, but if it is a genuine point that, say for example, the JDA terms say that the landowner's share would be sold by the developer and then given in cash. Till then, I do not even have any right in the apartment units. What will happen? Because typically that's what landowners do. To save the trouble of marketing, to save the paperwork difficulties, they ask the developer himself to see the transaction through. Right? In such cases, what would happen? Would the JDA not become a specified agreement for the purpose of 45(5)(a)? Point of deliberation. Right?
In case of CC, non-CC OC projects.
Definitely. What will happen then? Right? Those are those final aspects, those are those exceptions. Right? There again, we go back to limbo. We go back as if to the situation where 45(5)(a) was not there. Stamp duty value means the value adopted or assessed or accessible by any authority of the government for the purpose of payment of stamp duty in respect of any immovable property being land or building. This is fairly straightforward. Now let's go through some nitty-gritties on 45(5). Fairly simple section, only this big in the Income Tax Act. There are a lot of minor aspects which come out. Fairly beneficial section like I mentioned. It's a mandatory provision. It's not an option. It's not optional for the taxpayer once the conditions are satisfied. Alright. So, in fact, I think in one of the rulings on JDS and taxation, one of the points which was taken up by the taxpayer was that in the context of a JDA, the sale consideration is not determinable, or sometimes cost of acquisition becomes not determinable, and therefore, in light of BC Srinivasa Shetty, the entire charging and computation mechanism fails. The charging section fails, and therefore, in a JDA, when I enter into a JDA, there should be no capital gains tax. Right? This was what, this was discussed in Chaturpur's Dwarka, I believe. Right? So one of the arguments put forth before the Supreme Court was that because of BC Srinivasa Shetty and because of the peculiar facts, the charging provision fails, the computation cannot be done, therefore the charging section fails, and therefore it is not subject to capital gains tax at all. In those exceptions, can we still take that principle, assuming we satisfy other conditions in Balbir Singh Maini Insurance Science? It's still open for debate. Still open for debate. Can we still take that view? And therefore, what do we do? With all of this, what do we do? With all of this, all that we do is we push the capital gains to the year in which the units get sold. We push it from the year of the JDA to the year of the sale of the units. Because that is when we will really have that cash to pay the capital gains. Right? So, but once the conditions are satisfied, this is a mandatory provision. This kicks in. So you can't claim or plead relief on stamp duty, etc. For example, in 50C, 50D, we have this safe harbor on the stamp duty, 5% higher than the stamp duty, 5%. All of that is not there. Please bear in mind. If there is a slight variation, we take the other end of the stick. Right? Hopefully, over time, they will even this out and bring in these safe harbors here as well. But as of now, there is no such safe harbor. Yeah, again. So, this in fact, in genuine cases, is a very beneficial provision. So, before the post 2017, when matters came up before the tribunals and the high courts, not high courts still, but before the tribunals, the plea was made. There is an amendment to section 45, 5A has been introduced. Let these provisions prevail and let us push the taxation to the year of receipt of the completion certificate. That was the plea which was made before the tribunal. The tribunal said no. These are all prospective provisions. Please don't take it retrospectively. Yes, it may be for the benefit of the assessee, they will note it. But it is very clear that this, and especially this is a substantive amendment. 45(5)A is a substantive amendment. Therefore, we cannot give it retrospective effect. Therefore, the Bangalore tribunal very recently, about a year back, they had this case, specifically said that Hyderabad ITAT, Pune ITAT, all of them have said that this cannot be taken retrospectively. Applies only to individuals and HUFs, not to other taxpayers. Fairly understandable because the government was very clear that these difficulties are typical, these situations typically come up in the case of individuals and not in the case of corporates or non-individuals. Applies whether the individuals are resident or non-resident. Right? So these provisions apply whether they are resident or non-resident. However, as you will see in 194 IC, the TDS provision connected in this section, the TDS is at 10%. Alright? That applies only if the seller, the landowner, is a resident of India. So in the case of non-residents, it is 195, it still applies. Alright? I will discuss that briefly when I go ahead. Transfer of land or building or both can be under any forms under section 247 and not only 247(5) or 247(6). Right? So part performance should be satisfied. Right? Just visualize all of this before Balbir Singh Maini and after Balbir Singh Maini. Before Balbir Singh Maini, by default you used to invoke 247 clause 5 and say it is taxable, subclause 5 and say it is taxable. But after Balbir Singh Maini, we will have to be a little more circumspect on it. Yeah, so there is a by default that section 247 is triggered in the first place, else there will be no capital gains. Right? So Balbir Singh Maini shares science is absolutely important before we advise, before we take any view or advice on JDs. Year of transfer to be determined as per section 247 and not as per section 45. Right? So the year of transfer will continue to be that year of JDA for simplicity purposes. Right? That will not get shifted. The year we discharge the liability is when what gets shifted. Right? Only land and building is covered, not the whole gamut of removable property for section 216. So when we saw 247, 247.5 and 247.6, it specifically said immovable property for this purpose includes immovable property as per 216, meaning rights in the immovable property. So if you transfer rights in an immovable property, it is subject to capital gains tax. Right? But if you transfer rights in an immovable property, you will not get the benefit under 45.5. Because rights in an immovable property is not land or building. And rights in the land or building is not land or building. They are two distinct assets. So we get this beneficial provision only for land and building. Relevant year of taxation is the year of issue of completion certificate. Alright? This we need to distinguish between date of actual completion, alright? Date of application for completion certificate, date of completion certificate itself. Alright? Because typically, at least in Karnataka, etc., the time gap is not significant. But if the date of the completion certificate is March and it is issued in April, alright, it makes a difference. Right? That is something which you need to track. Can certificate of completion be issued for part of the project? If yes, would this scheme apply to only part of the project proportionately? Right? So he sold out this land parcel to a developer. It's a 400 apartment unit project. 4 towers of 100 apartments each, 4 different towers. Typically, we see the BBMP issue completion certificates for 1 tower. Alright? So for the other 3 towers, they are not yet complete. Now we need to compute capital gains only for that proportion. Right? So for what proportion has the completion certificate been issued is something which we put.
So here the cost of taxation will be on date of JD, but stamp duty will be on date of completion.
Yeah, I come to that point. Stamp duty will be on the date of issue. Now indexation I will come to that. It's a very valid point. We come to that. Full value of consideration is not with reference to the asset transferred, but what the asset received. Right? Look at this again. When we sell shares, whatever money we get on the shares which we sold is the sale consideration. Right? But here look at the peculiarity. This is an academic point, very interesting. What we sold is not what got taxed. What we got is what got taxed. In that sense, the value of what we got is what got taxed. In that sense, it's fair because it's finally money's worth. Again, that money's worth is a notional item of stamp duty. Right? Some finer aspects here because 5A is peculiar compared to other subsections of 45. Right? And therefore, I mean, generally, academically, if we simply stand back and read 45, each subsection is a different specimen by itself. 5A again joins that league. This is one more specimen subsection which is. Again, so this point which I was mentioning, full value of consideration is received only in cash, provision would not apply. Alright, this is something which I don't know, we can look at both ways. The department can go against us saying I will not give you this benefit. The associate can say I will not apply 45 because of this reason. Right? You need to track this very closely. Full value of consideration is stamp duty value on date of issue of completion certificate plus any cash consideration. Right? Now, again, this point which I was making, this 5% benefit beside the same is something which we will not get. Although we can plead, right? We can plead to the appellate authority on this. So we are pleading which we have. Indexation and difficulty measure, which CPs are mentioned. Indexation whether to be applied till date of issue of completion certificate or till year of transfer under section 247. Right? So the fair view. We again, where this comes from is why do we apply indexation? To give the benefit of the inflationary dimension to the sale consideration. When did you receive the sale consideration? Year of completion, year of issue of completion. So the fair view would be to push it to the year of issue of the certificate of completion and not the year of transfer. So JDA entered in 2020, certificate of completion received in 2028, indexation up to 2028, right? But this will be contested extremely hard by the income tax department, right? And they have one more, they have some rulings in the context of conversion of capital asset into stock in trade into capital asset. We say that you have to hold the indexation till the date of conversion, not to the date of the sale of that capital asset. Right? They rely on that principle to deny us that benefit. Right? So we have to work around a little more to build that argument. So this was the point which I said. If you give a strict reading, you have to restrict it to the point of transfer, year of transfer. Right? But if we do a purposive reading of the concept, whole concept of indexation, we should be pushing it to a subsequent point. Then the next question comes: relief under section 54BC. When will you compute it from? Transfer 2020, JDA 2020, tax paid 2028, 54EC 54F from 2020 or from 2028. Right? Again the same principle. I did not have the money to invest in 2020 when I entered into the JDA. Therefore, please push it to 2028. It's the same premise. The proviso. Transfer of share in the project on or before date of issue of completion certificate. Would share require identification of mere proportion for JDSFI? So again, let's take that 400 apartment units, 4 towers. First tower gets completed, capital gains is paid. Before the second tower gets completed, the landowner transfers his share, the balance 3 towers to somebody else. Then, does he forfeit? Proviso triggers and says 45 highway does not apply. I have applied 45 highway and paid taxes on the 100 apartments. Now, will it take me back in time to 2020 and say, no, you should have paid tax on the 400 units point. Right? It sounds extremely absurd. Right? And this absurdity is what we should underline when we try to understand this proviso. Right? We read this proviso, see the absurdity which gets triggered if we read it too harshly and then say, boss, this is unreasonable. Again, law and reason, we know how they get around, but we need to keep that in mind always. Would share in the project need to be fully transferred. Right? 400 apartments, 100 towers already offered to tax, 300 apartments, I keep 200, 100 only I transfer. Will this still get triggered? This is the only tricky part of this section. When they said share in project, they did not clarify whether it is full share or part share. Right? Because there will be a school which says the department will say part of a share is also a share. Right? You will get an counter view, no doubt. But then this is one slippery slope. Right? What if it is partly transferred? Situation where books 45(1) and section 45(5) would apply. Would this be the case? This is that absurdity which I was talking about. Right? Need to deliberate this a little more and get more scenarios. And to the extent it borders on absurdity, that's when we'll have to step back and take a more pragmatic view of things and explain it to the assisting officer and say, boss, please be reasonable. And hope that the tribunal appreciates this final aspect. Capital gain in the year of transfer of the share, not year of original transfer. Alright? The capital gain applies for section 45(1) in that year. Alright, again, we go back to this concept of part performance, legal rights being transferred and all that. Right? That's the important dimension of this proviso. Damned if you do, damned if you don't. Damned if the proviso gets triggered, damned if the proviso does not get triggered. Right? That would be the difficult situation. What would be the period after which indexation would be considered if the proviso gets triggered? So, when the proviso is very meaningful, the implementation of the proviso is going to be a nightmare. Right? What is the period of computation of relief under sections 54EC and 54F if the proviso gets triggered? Because the transactions already happened. Lot of water has flown into the bridge. And then I transfer the share. I lose out on 54EC which claim it in the year of the occupancy certificate and the completion certificate. I lose that out, right? Very far-reaching dimensions in the proviso gets triggered. In such scenario, full value of consideration will be actual consideration read with sections 50C and 50D. Again, we go back to stamp duty value and we get taxed. Yeah. When the proviso triggers, there will be two capital gain transactions. One is the entry into the JDA itself, which has to be offered to tax. The other is the sale of the share which will get taxed. There will be two transactions when the proviso gets triggered. There will be two transactions when the proviso triggers. Right? Very sensitive, touchy point is proviso. Again, capital gain computation of the share in project is a distinct exercise. So we are setting the share in the project, we have to compute capital gains. That itself is one exercise which we have to do. How to identify costs for share of project? For existing guidance on section 48 or 50D, not section 50C. All this again, no, here again, just BC University come to the SP saying I can't compute the cost of acquisition, etc. Can I say the charge fails? Right? So this proviso is a fairly tricky point which we'll have to keep in mind, and that's where the understanding of the specified agreement becomes very critical. Again, it's a registered agreement, unregistered agreement outside the ambit of income tax itself. Because we saw the releasing money, we said unregistered agreements, no way you can charge capital gains tax. Okay? Land or building or both, no other asset or immovable property or section 260 anyway agrees to allow other person to develop a real estate project. Alright, now real estate project, what is a real estate project? Right? What is a real estate project? Land or building or both. Right? Plot development, whether it comes. Other person need not be individual actually. Real estate project not defined. It could be residential or commercial. Alright, no distinction between that. Plot development, would that come under a JDA? Right? Plot development, whether that comes under a JDA and 45 highway, right? Could come. Nothing stopping them. Right? Consideration of a share, a land or building or both, with or without payment of consideration in cash. Yeah, this is something which we discussed. Lastly, TDS under section 194 IC. So 194 IC is a special TDS provision which has been introduced to address the charge under 45 highway applied to consideration in cash. So only the cash component in this arrangement will be subject to TDS, not the component in kind. Only the cash component gets subject to tax reduction at source, applies at 10%, applies when payment is made to a resident. So when it is made to a non-resident, 195 comes in. Alright, 195 comes in, and the uncertainty of the tax rate, the uncertainty on the quantum on which the tax rate has to be applied, whether on gross or net. Right, and the importance of lower tax reduction certificate becomes very important. Right? If proviso to section 45 5A applies, then 194C still apply, or should 194 8A apply? Look at the situation here. So the JDA was entered into. We said 45 5A, and then for subsequent sale of a share for proviso gets triggered. Alright, on that non-refundable advance. As of today, on the non-refundable advance, the 1% TDS is done. Alright? Now, because I say 5A and I don't do the TDS at 1%, right? And because of the proviso, 194IA should have been done. Alright? We go into a circular reference. Alright? This is one chink, so to say, which is still against us. Again, is this section because 45 only to the extent of payment being made under a specified agreement. Right. So with that, those are the points which I had.
When this TDS will be claimed, the 10% TDS? Because I will be paying tax only on CC.
Correct. So 194 IC triggers in the year of the CC. Correct. Again, there is a mismatch over there because look at it this way. This non-refundable deposit, I paid it in year 1. Alright? And then at that point in time, I don't know whether I am satisfied 5A. I do not know. So should I do it at 10% in that year and get a declaration from the landowner saying he is going to offer it to tax under 5A. So I think for the developer, the right thing to do would be to say, again, but then I'll tell you the story of the landowner what will happen. If the developer says I will do it in year 1, right? The landowner will say, boss, I have to carry it forward, carry that credit forward. I am not offering that to tax in year 1. I am offering that to tax in year 8. Can I claim a credit of that? Fortunately today the return form allows me to carry it forward. Right? Therefore I am safe. If not, that would have been an issue. But again, the developer would be happy and say, boss, I am paying tax in the subsequent year. And I am sure on that 143, when intimations will come, the landowner's life will be end. Right? Because they will say, there has been TDS done, but income not offered. Right? We'll have to explain all of the story to them. We have to teach them 45 days. Right? Because of the difficult things with this. Points to track whether taxation triggered considering principles and values in many societies. With the JDA, today the first thing to do is read these two rulings. Right? I've summarized the principles, but those rulings are very nice to read. Although share size is a very difficult ruling to read because it's extremely cryptic and the facts are all over the place. Producing mine is a good read. But this is something which we have to see because the consequences are far-reaching. Right? Whether taxation triggers for 45(5)(a) or 45(1) as proviso to section 45(5)(a) trigger, all of this, just imagine the landowner comes to us and he says, boss, I am entering into this JD, please tell me what to do. We will have to stand back and think and speak to our client. Right? The completion certificate would be issued partly or only for a project we discussed. Stamp duty value of the date of the JD and date of issue of completion certificate. We need to track all of this and be sensitive to the nuances here. That's all that I had this evening. Happy to take any questions. Hope the discussion was useful and you guys found it relevant. Thank you, Untitled Chapter and committee members once again.
Thank you, sir. We had a wonderful session. On behalf of the branch of SIRC of ICA, I thank you for the wonderful session. I request Upad Manning to present a moment. Thank you all for the patient hearing.